This is Al Brooks, and this is my price action trading course. The current module is about protective stops. What's the purpose of a protective stop? It's to protect you against yourself, not to protect you against the market. Emotions can influence your decision making, and without a stop working at all times, you'll sometimes let losses grow and grow and grow and grow. And it will take many, many successful winning trades to make back the losses that you allowed to occur. If you have a protective stop, you can protect yourself from making that mistake. No matter what size stop you choose, you have to make sure that the total dollars at risk are within your comfort zone. Are you going to risk $100? Are you going to risk $1,000? Whatever your comfort zone is, never risk more dollars than what you're comfortable losing. If you're worried about losing money, you will lose money because your emotion will interfere with your trading decisions. And if you're using a very big stop, make sure to trade a much smaller position because you don't want to trade a much bigger stop than usual with your normal position size because you'll be risking far more dollars than you normally risk, and that will make you nervous, and you will not manage the trade objectively. You'll lose money. So let's say your stop has to be 3 times bigger than what you normally like to use. Then your reward, remember your reward is always at least as big as your risk. So your reward has to be at least 3 to 6 times bigger than usual. Okay, which is good. You're making a lot more profit. However, because your risk is 3 times normal, if you don't want to risk any more dollars than you normally risk, you have to trade small, like 1/3 your normal trade size. Okay, you can, if it's a trend, you can swing part of your trade or all of your trade. There are always trade-offs among the 3 variables in the trader's equation: risk, reward, and probability. A swing means you're going for a big move and a big reward, but there's a trade-off. Big reward usually means low probability, and the probability is often as low as 40%. In some of the best setups, like major trend reversals, the probability is usually between 40 and 50%. But if you're swinging, you're going to get a reward twice as big as your risk, or more than twice as big, and that still results in a very favorable trader's equation. In all trading, you have to make sure that the profit target is at least as big as the protective stop, right? You always want a reward at least as big as your stop. In a bull trend, you have higher highs and higher lows, and it's contained within a rising channel. The bottom of the channel is the bull trend line. Since a bull trend is made of higher highs and lows, as long as the market continues to make higher highs and lows, it's still in a trend. If it stops making higher highs and lows, it's not in a trend. So if you're holding a swing based on the premise that the trend is continuing, and it's no longer continuing if it falls below the most recent higher low, in other words, it's making a lower low, most swing traders usually trail their stops below the most recent higher low. So every time the market makes a new high, they raise their trailing protective stop to below the most recent higher low, because if the market stops making higher lows, in other words, if it falls below the most recent higher low, their premise is no longer valid. The market's no longer in a trend. It might be in a trading range, and the trend might be over. A bear trend is a series of lower highs and lows, and it's contained within a falling channel. The top of the channel is the bear trend line. Since a bear trend is made of lower highs and lows, swing traders usually put their protective stops above the most recent lower high, because if the market goes above that high, their premise that it's a bear trend may no longer be valid. So they're betting on a bear trend continuing, making lower lows and lower highs. If it goes above a prior high, it's making a higher high instead of a lower high, and it may no longer be a bear trend, and a lot of the swing traders will get out once the market stops making lower highs. Whenever you're in a position and you have a protective stop working, the protective stop is there to protect you from a loss that could grow very large. However, you only stay in the position as long as your original premise is valid. If you're looking at the market and the market's going against you and you believe that what you believed when you put the trade on is no longer true, don't wait for your stop to be hit. If, for example, let's say you bought thinking the market was always in long, and then the market did something to make you believe it was now always in short, even if it has not yet hit your stop on your long trade, you get out immediately. It does not make any sense for you to continue to rely on a stop based on a premise that is no longer true. So the stop protects you, but you also should actively protect yourself. If the direction of the market changes or if something happens so that you believe your trade is no longer sensible, don't wait for your stop to hit. Just get out at the market and take the loss. Some people use very wide stops when they trade. For example, a measured move away from a trading range. And their intention is for the stop never to get hit. They're trying to give themselves room. They're not sure, for example, if they're buying, they're not sure if they bought the exact low, but they think that the market is in the process of reversing, and they're willing to allow it to go lower. However, they'll sometimes have a stop that is very far away. They'll trade small enough so that if the stop gets hit, their losses are not too big. However, if the market does go below their entry price and does something to make them think that their premise is wrong, that the market is not bottoming, and in fact it's trending down, maybe it's in a bear channel instead of in a bull pullback, maybe the pullback has grown so far that it's probably now a bear channel and a bear trend. Even if the market is far from their protective stop, their original idea is wrong. They get out immediately. That wide protective stop is just to protect them in case of catastrophe. For example, in case their data went down, in case their internet went down, in case their broker software went down, in case who knows what, in case they get a phone call, in case something happened, right? That protective stop is to protect them from a disaster. However, they should not rely on only one means of protection. And another obvious means is once you believe your idea is no longer true, don't just hold on to the position and hope that the idea once again becomes true, right? You have a responsibility to do the right thing, and if your premise is wrong, you should not be holding a trade based upon a premise that's no longer valid. Just get out immediately and take the loss. Here's an example of scaling into a bear trend. The market gapped up but then sold off and had 3 strong bear bars here. So it became always in short for most traders, certainly by this bar. For most traders, probably by this bar. There was a trading range, a breakout, and support down here at yesterday's close. Most traders would assume we're going down to test yesterday's close, and that maybe we'll get a trending trading range day, an upper trading range, a breakout, and maybe a lower trading range. Okay, to me, I think this is not a high probability short. If you take it, you may be taking a trade that has a 40 to 50% chance of success. You're taking it as a swing. Your stop is above the most recent lower high for a swing trade, so initially your stop is up here. And since it's not a highly probable trade, you're hoping to get a reward equal to twice your risk. So your risk is from the stop to your entry price, 1 tick below the signal bar. You entered right here. And then a measured move down to twice that distance, which is well below the bottom of the screen. You could convert the trade into a smaller profit based upon actual risk after entering. I talk about that in another module on actual risk. But for right now, let's assume you're going for a reward twice your risk because it's not a high probability trade, and let's say you take that short. you certainly were not happy by this close, right? You don't want it closing above the bottom of your signal bar with a big tail. Possible parabolic wedge. There's a slope across the bottom here and a steeper slope here, so it's parabolic, and it's 3 pushes down, so it's a wedge. It's possible that this is becoming the low of the day. But let's say, for argument's sake, you took the short and you're willing to sell higher, maybe on a 50% pullback with a stop up here. So if you normally trade 100 shares of the spider, maybe you shorted 100 here, planning on putting another 100 here on and exiting everything up here. But you'll also exit if your premise is no longer valid. At this point, with these 3 bull bars closing, 2 of them closing near their high, 2-bar reversal, strong breakout bar, 2-bar reversal with this bar or that bar or both. We did not quite get down to yesterday's close. We have tails on the bottoms of these 4 bars, and we have some buying pressure up here, decent bull bars and tails. The day at this point is probably back to always in long. So if you shorted here and your premise was that the market's in a bear trend and that you were going to scale in higher, maybe 50% pullback somewhere up in here, by the close of this bar, you'd have to conclude the market is always in long. So your original premise is wrong. You thought that you were in a bear trend, and now the market is always in long. So what do? Do you scale in and hope to get out, break even on the entire position, maybe exiting somewhere in the middle of your 2 prices? No, that's not what you do. You've now concluded that the market is always in long, and you're short. You can't do that. You have to get out immediately at the market. As soon as you decide that your premise is wrong and that it's now a bull trend and always in long and going higher, you have to get out at the market and take your loss. And it's as simple as that. This leg down, 3 consecutive bear bars is good. However, it's still within yesterday's range. Yesterday's range had a lot of reversals. We have many reversals going on here, and prominent tails and decent bull bodies. Certainly 3 good bull bodies here. So this is probably a bear leg within a trading range. It's possible that this is the low of the day, but a bear signal bar, that to me is not reliable. So I suspect that the day will be a trading range day. And this is how it ended up. This low 1 short became a 1-bar final flag. We had a parabolic sell climax, 1-bar final flag, and a reversal up, always in long. There was some follow-through buying, and there was even a second leg up. But ultimately, we went down to a new low in the day, and then reversed up again. That's what trading ranges do. They run above resistance. Remember, the swing stop for the bears was above this high, and the market went above it, only to turn back down. New low of the day, and then turn back up. And that's what trading ranges do. They run stops, they run below swing lows and reverse up, they go above swing highs and reverse down. For protective stops, you have 3 choices. You have a price action stop, like beyond the signal bar. So let's say you're buying a reversal up and you have a very strong bull reversal bar. That's your signal bar. A price action trader might place a protective stop 1 tick below its low. Sometimes traders use a money stop, like a certain number of ticks from their entry price. So let's say a trader is buying a strong bull spike at the market. They may put a protective stop 10 ticks below. Also, traders often use measured moves for their protective stops. So if they're buying in a pullback, for example, and they're not sure that the pullback has ended, they may make a calculation of a measured move, maybe based on the height of the pullback, and put their protective stop there. So again, a price action stop based upon the bars on the chart. The price action, if you're buying a bull reversal, you put the stop 1 tick below the bottom of the signal bar. If you're selling at the top, and you have a bear reversal bar, a bear signal bar, and you short below the signal bar, your protective stop is 1 tick above the signal bar. Let's say you have a very big signal bar. A lot of traders won't want to risk that many ticks to beyond the signal bar. but they might be willing to risk to beyond the middle of the signal bar. They can also, so they can put a stop, they can find out where the middle of the signal bar is and place a stop a tick or two beyond that. They may also use a money stop, like 10 ticks from their entry price or 50 ticks from their entry price. That's also a valid approach. Here's an example. Look at the size of this bar compared to the other bars on the chart. It's 2 to 3, 4 times bigger. Very big signal bar. So if a trader shorted the close or shorted below the signal bar, let's say they shorted 1 tick below the low and they got filled over here, a lot of traders might not want to risk to above the top of the bar. It'll be too many ticks. And maybe they don't want to trade that small. Instead, they might trade their normal size position and put a protective stop just above the midpoint of the bar, for example, right here. That is a reasonable thing to do. And then as the market trades down, they can tighten their stop. Here's another way to handle this. So instead of putting a stop above the midpoint, and instead of using a price action stop above the top of the signal bar, they may simply say, well, I always risk 8 ticks in the E-mini, 2 points in the E-mini, so I'll just go ahead and I'll use a 2-point stop. And in this particular case, that worked. Let's say you have an expanding triangle bottom, which is a type of major trend reversal. Your minimum objective, your profit target, is above the top of the triangle. The reward is usually much bigger than the risk. So we have a bull signal bar at the bottom of the expanding triangle. A price action stop is 1 tick below the bull signal bar. You buy 1 tick above the signal bar, so you get filled over here. Your stop is here. You could do that, and that is a reasonable approach, using a price action stop, a stop below the signal bar. You could also use a money stop on that same trade, a reasonable number of ticks from your entry price. For example, your money stop might be the size of your average bar. For day traders, that might be about 10 to 20% of an average daily range. So, for example, let's say you bought above this signal bar, and you're deciding on how far away your stop might be. You might want to put it a reasonable number of ticks below your entry price. And let's say you're trading the E-mini, you might decide, I usually risk 10 ticks, 2.5 points. I'll just place my stop at 2.5 points. And I'll allow the market to trade below the signal bar, but I will not allow it to fall 10 ticks below my entry price. So a lot of traders think, well, I'm good at picking approximately the bottom, but I'm not very good at picking the actual bottom. So for example, if I bought here, look, it fell a tick or two below my the low of the bear, and it turned up. It might do the same here. So rather than exiting with a loss at 1 tick below my signal bar, I'll use a wider stop, maybe 10 ticks down, and I'll try to hold for a measured move up. So if I'm risking 10 ticks from my entry price, I'll try to take profits at least at 10 ticks above my entry price. You could also use a measured move target to help determine where to put your protective stop. You can base it on several things. You can base it on the height of the signal bar. You can base it on some kind of a gap within the pattern. Or you can base it on how far away your profit target is. So again, this is that same expanding triangle bottom. You could use a protective stop based on the height of the signal bar, saying, okay, I'm buying here. I'll put a stop equal to the height of the signal bar, which would be down here. A reasonable thing to do. If the market is going to reverse and you did not pick the actual bottom, it probably will not fall much further. You can see over here it fell below, but not much further before it found buyers here and here. Here it fell below, but not too much further before it found buyers. Over here it fell just a little bit below. And had you bought any of those areas here and put a stop this number of ticks below the swing low, your stop would not have been hit, and you would have been able to make at least a scalp up. So using a measured move target based on the height of the signal bar, that's a reasonable approach. Most traders do not use that approach. They use other approaches. And you could also use a measured move based on the height of a movement from a gap. So, for example, here we had we have a measuring gap here. The close of the bar is below the low of the prior bar. The pullback after the breakout bar came to below the low of this bar. This gap is the distance between the breakout bar, this low, and this high. So this, once the market started to turn down, you can look at this and say, that could be a measuring gap. And it turns out that the market reversed up right around a measured move down. Traders might say, okay, I'm not really good at picking the exact bottom. Let me go for a wide stop based on the height of that measuring gap. So my stop would be down here. And if that is the case, you'd go for a measured move up the same number of ticks. So if you entered here and you put a stop down here, you'd need to go for a measured move at least equal to that same number of ticks. So your minimum target would be somewhere up here. Most traders would not take this approach, but it is a mathematically sound approach. Here's an example using an extreme stop, an extremely large stop. The market is in an expanding triangle. A decent looking signal bar, so the context is good, expanding triangle. All expanding triangles, bottoms are lower low major trend reversals. We have a trend line, I did not draw it. A reasonably strong break of the trend line and the moving average. Gap bars, lows above the moving average, usually leads to the final leg before a significant reversal. And then we have a lower low reversing up. So it's a lower low major trend reversal and an expanding triangle with a good signal bar. So the context is good and the signal bar is good. This is a reasonably high probability trade, maybe 60%. 60% means the probability of the next 2 points up is greater than the probability of the market falling 2 points. The next 3 points up greater than falling 3 points. The target is the top of the expanding triangle, and that's about 5 points up. So the probability is maybe 60% chance that the market will go up here 5 points before it falls down here 5 points. So this is a reasonable catastrophic stop. Like all stops, if the premise changes, you get out and you don't wait for the stop to be hit. No one using a stop this wide is simply going to take the trade, get long, and then walk away and wait to see if their profit-taking limit order got filled before their stop got hit. Although mathematically that is reasonable and it results in a positive trader's equation. If a person saw something happen after they entered that made them believe that the bottom is not in and that it's now a bear trend resumption, and let's say they decide that somewhere down here, right? Let's say we get a strong bear breakout, something like this, okay? 2 or 3 strong bear bars below this low. At that point, they're going to say, well, the bottom failed, and the market is now back to always in short, and it probably will have a leg down equal to some measured move target. And the obvious one would be the height of the triangle, so this would be the target. So if they conclude somewhere in here that the market now is always in short, and that the bottom failed, and that the market is probably going to reach a measured move target down here, they're not going to continue to keep their protective stop here and wait for it to get hit. As soon as they believe that their premise has changed, that this is not a bottom and that the bear is resuming, they're going to get out. So people who use these very wide stops rarely ever let these wide stops get hit. They exit long before then. They use the wide stop just in case the market does something very quickly and then reverses and goes their way, and they don't have enough time to make the decision. Wait a minute, did the market just flip to always in short? What's going on here? The wide stop gives them time to think. They can leave the stop in until they can clearly make a decision. Yes, the market has become always in short. Oh, okay, I'm going to get out at the market down here or down here and not wait for my stop to be hit. Or they'll decide, oh, that's just a stop run, going down 2 or 3 points below this low, and it's now a climactic sell climax, and it will be followed by a strong rally. The very wide stop gives them time to think. But once they do think that their premise is no longer correct, they're going to get out. So whenever someone uses a very wide stop like this, it's just to prevent a catastrophe from happening. If their data goes down, if their broker goes down, if the internet goes down, and they're long, they want to make sure that there's some limit to what they can lose, so they use this very wide stop. However, if at any point they decide that the trade is no longer good, they're going to get out immediately. They're not going to rely on the stop. So most of the time, when you use an extremely wide stop, you have no intention of ever letting the stop get hit. You'd get out long before. But it does give you time to think. And once you've had that time, and once you've come to your conclusion, whether or not a break below this area is simply a sell climax that will lead to a reversal, or whether it's a resumption of the bear trend and therefore there's no bottom and the trend will keep going, then you decide what to do. If you think the bear is going to continue and that there is no bottom, you get out. And once the market starts to turn up, then you convert the stop to an actual risk stop. So for example, at this point, and certainly by this point, traders would be thinking the market's always in long. So at that point, they would put their stop below the signal bar, the bottom of the bull spike. And then their actual risk is from their entry price, one tick above the signal bar, to the now new protective stop, the trailing stop, below the signal bar. And they may take part off at 2 times that risk, which would be somewhere around here. And that's probably why the market went sideways here. Probably a lot of traders took partial profits at 2 times the actual risk. Okay, a wide protective stop. A lot of traders feel like they're not very good at picking exact tops or bottoms, but they're willing to risk more than beyond the signal bar because if their premise is still valid, they'll allow the market to go against them a little bit and bet that the market will go their direction very soon. I just gave several examples of how to use wider protective stops, and the trader's equation always has trade-offs. If you're using a wider stop, you're obviously risking more money, but you usually receive higher probability of success in return. So the wider the stop, the more likely you'll make a profit. However, when you do lose, you'll lose more ticks than you would with a tighter stop. If you're using a wide stop, you have to trade smaller size to keep your total dollars at risk the same. So you have to adjust the size of your position. As your profit grows, if your swing stop is very wide, make sure to take profits to scale out of your trade to reduce your position size. You hear me many times in this course talk about trading small, especially when the stop has to go far away. However, for option traders, they can use stock replacement strategies as an alternative to trading small. For example, let's say the market is in a strong bull trend and the stop has to go 3 times further away than you normally want your stop to be. What an options trader will do, or what a stock trader who also trades options will do, is he'll sell out of his stock and he'll replace his stock with an option strategy. The most obvious and easy ones are he might buy a call or a call spread. If the market's in the breakout phase of a bear trend and there are no pullbacks and the stop has to go far, far above where you are right now, an alternative to trading very small and putting the stop far away is to sell out of your stock and buy back your short and replace it with a simple option strategy. For example, buying a put or buying a put spread. And therefore you immediately greatly contained your risk. For example, if you buy a put, the most you can lose is the price of your put. And that might be 1 or 2% of the current price of the underlying stock. So your risk has become greatly smaller by replacing your stock position with a position in the options market. A lot of traders don't trade options, but that is a very popular strategy for traders who trade both stocks and options. There are other more advanced strategies like collaring up, but I'm not going to go through them in this course. I might do that in a subsequent course. Your initial protective stop, that is the size of your initial risk, and therefore it determines your initial minimum target. You want a target at least as big as your initial risk. You can start with any logical protective stop, and that is your initial risk. And again, you need to go for a target at least as big as your risk. Okay, so let's say you bought above the high of this bar, and you decided to use a very wide stop based on a measured move down on the height of this last bear leg. So your stop is down here. All right? And let's say you bought above the high of that bar. You would not have been stopped out here. You're using a very wide stop, so you have to trade very small. And your target would be at least as big as your risk. So somewhere up in here. That's based on your initial risk. Most traders ultimately do not base profit targets on initial risk. I'll talk about that in a minute. Traders adjust their initial stop after the market goes their way. And this is optional, but it makes sense, and it reduces risk. It also reduces probability, but it reduces risk. So, for example, here, if you bought one tick above the high of this bull signal bar, and you had an initial stop way down here, that is your initial risk, and this is your initial target. Okay? When you look at the chart at the end of the day, you see that the market never reached your initial target, right? However, that's not the point that I'm making here. That is your initial risk, and that's not your actual risk, and that's not your actual target. That's your initial target. Had the market gone down further but did not hit your stop, you would, and then it reversed up and started to go towards your target, you would have been happy that you had such a wide stop. Alright, so after you're in the trade, let's say the market goes against you a little bit, and then it starts to go your way. You can count the number of ticks that you would have had to have used for your stop to avoid being stopped out. That is your actual risk. And you can go for a target based upon your actual risk, which is always at least as small as your initial risk, and usually smaller. When 2 times the initial risk is too big, you have to give thought to other ways to take profits. This is common in trading ranges, where there are often pullbacks after the entry, and the signal bars are sometimes large, and it's simply unrealistic to go for a target that's 2 times the initial risk. What you can do is instead go for a target that's 2 times the actual risk, and if the setup looks like it has a high probability of success, you can exit at 1 time the size of the actual risk. So for example, if you're trading the spider and your actual risk is 10 ticks, you could go for a 10 tick scalp. I would never go for smaller than a 1 point scalp in the E-mini or a 10 tick scalp in the spider, because otherwise commissions and slippage become too large. So let's go back to that same chart. Okay, so you bought above the high of this bull signal bar. Your initial risk was down here, so you did not get stopped out on the new low here. But then the market started to go your way, and by the end of this bar, you can say, if I had a stop 1 tick below the low of this bar, I would not have been stopped out. So I actually did not have to risk all the way down to my initial risk. My actual risk was from my entry price to 1 tick below the low of this pullback which fell below my signal bar, but did not hit my initial protective stop. So this is my actual risk, one tick below this pullback bar. So when this bar closes up here, you look back and you can calculate what your actual risk was, and then you can change your profit target to equal to your actual risk. So this is the measured move based on the actual risk. Actual risk, entry price, measured move up, that's your profit target. And you can see that a lot of traders did that. You can see the tails on the tops of these two bars. So a lot of selling took place. A lot of it was bulls selling out of longs. Okay? This is how most traders trade. Okay? Nobody talks about it, but this is the reality. Most traders trade based on actual risk. A lot of traders don't think about it. They're much more subjective. But in actual fact, mathematically, you'll see that the market often makes pullbacks exactly in the area of actual risk. And that tells you that a lot of the computers are using actual risk for profit taking and for taking trades in the opposite direction. Okay? This is an extremely important concept, and it should be incorporated in all of your trading. Going back to that same situation, okay? If a trader bought above this signal bar and they had an initial stop here, and then they immediately get a second really good-looking signal bar, it's a second signal, higher probability, a lot of traders will buy more one tick above this bar. At that point, they may put their stop below the second bar because at that point they're taking a second entry long and it's a very good-looking buy. They don't want to hold the position if the market falls below that second signal bar. So most traders would then put their protective stop below this second signal bar. Whenever you're taking a second entry long, you don't want the market to come down a third time. It came down once, it came down twice. You bought once, you bought twice. Most traders will get out below that second signal bar. And that's the correct thing to do. Let's say you have a second signal after you enter. A lot of traders will buy more. Okay, for stops and strong breakouts, a trade-off among the three variables in a trader's equation. Now, the probability is very high. If you have high probability in a strong breakout, there has to be a trade-off, right? You can't have high probability, high reward, and low risk, right? In general, whenever you have a high probability trade, you need a pretty wide stop. That's the trade-off. You have to. Okay, let's give a specific example. Okay, here's a very strong bull breakout, very strong bull trend. Once you're up in here or in here, everyone knows the market's always in long, and it's probably going to have a second leg up before it falls below the bottom of the spike. So traders will look for every reason to buy in here. They'll buy above the high of the prior bar. They'll buy below the low of the prior bar. They'll buy bear closes, right? They'll buy bull closes. They'll buy a breakout above a prior swing high, right? They'll be buying for any reason, confident that the market will go and have at least a second leg up, okay? Let's say you bought anywhere in here and you're looking for that swing up. You have several choices for your stop. This strong breakout bar closing on its high above the high of the day and way above this high is where the traders started to think that the market became always in long. So traders might place a protective stop one tick below the high of this breakout bar. That would be the tightest stop that a trader might use. Other traders may say, well, the trend really began with this very strong bull bar, so the market should not fall below its low, so they'll place a stop below the breakout bar. Other traders who bought, let's say they bought one tick above this signal bar, they may put their stop one tick below the signal bar. Once they saw this strong entry bar, they may place their stop one tick below the entry bar. All of these approaches are good. They're all sensible, good approaches. The wider the stop that you use, the higher the probability that you'll make a profit. But you're also having a greater risk, so the few times that you do lose, you'll lose many more ticks than you would have lost with those tighter stops. When you are using the wider stops, you have to adjust your position size to keep the total number of dollars at risk. you can see we had this strong pullback here. It did not close the gap above this breakout point. So we had a gap in here, and it probably resulted in a measured move up, although I did not calculate it on this chart. So from the low of the move to the middle of the gap, which is right around this green line, a lot of traders would look to take profits at a measured move up. Protective stops serve a purpose. They protect you from yourself, and don't pretend that they'll never get hit. They do get hit, and that's what they're there for. If the move is going against you and you did not exit early enough, your stop will get hit and you'll take a loss, but that's okay. Remember, if your stop is 2 times further away than you normally would like to have it, you trade half size. If it's 4 times further away, you trade quarter size, because you always want to trade small enough to keep your risk within your comfort zone. You never want your risk bigger than what you're comfortable losing. And if you buy late in a trend, for example a bull trend, or sell late in a bear trend, you rely on your stop even though it's far away, as long as your premise remains valid. If your premise changes and you decide, hey, this trade is not good, then get out at the market. If you're not sure, rely on your stop, and don't worry if your stop gets hit, because even if the stop is 3 times as many ticks as you normally like to use or for a stop, you're trading 1/3 size, so your loss is no bigger than with any other position. Here's an example. The market gapped down big, went probably always in long above this first bar of the day. Certainly during this bull spike it went always in long, and since it's always in long, you can buy at any point and rely on your stop. Since you believe it's a reasonably strong bull trend, your stop would go below the most recent higher low down here. So even if you bought way up here at this close, you put your stop down here, and you say, well, wait a minute, I only want to risk 20 ticks or 25 ticks in the spider, and this is 3 times bigger than what I want to risk. Well, then you trade 1/3 your size. And as long as your premise remains valid, that the market is always in long, rely on your stop, and don't worry about it. If your stop gets hit, you don't lose any more than you do on any other trade. During the sell-off, we had a bear breakout, but followed by a bull bar. We had another bear breakout, but followed by a doji bar. So this is not behaving well for the bears. So yes, we're trending down, but it's not flipping to always in short. So for me, it still is always in long. And if I bought here, I would hold long and rely on my stop, even through all of this. Down here, we probably are forming a double bottom, bull flag, so you could buy above here. You could even buy above here. And a higher low major trend reversal. The market was in a bear trend. We broke it strongly. We broke out of the trend strongly above the trend line, and we formed a higher low major trend reversal. So to me, if I had bought this tick, this way up here at the top, and I had my stop down here, I probably would double my position here, or certainly add a piece more on here. And if I bought here, I probably would raise the stop for my entire position to below the double bottom. And as long as the market remains always in long, it's okay to hold long and rely on your stop. Here's a similar situation. A gap up, strong bull spike, follow through, market's always in long. Good follow through here, and another bull bar here, so follow through after this breakout. So let's say you bought way up here, right at the very top of the market, and you decided, okay, I think it's always in long, I'm going to bet that we get follow through. And then you look and say, well, wait a minute, my stop is $1 away. That's 5 times or 4 times. Let's say it's 4 times bigger than I normally will risk on a trade. Well, if you do buy here, then you trade 1/4 size. So if your stop gets hit, you lose no more than you do on any other trade. If you held through all of this, you would have been stopped out, and the loss that you had would be 4 times as many ticks, but since your position size is 1/4 your normal size, the loss would be no bigger than with any other trade. Now, I hold long even if I buy the high tick until my premise changes. And in this particular case, we have a very strong bull trend, trend line break for about 10 bars, and then a lower high with a bear signal bar. Arguably this is a reasonable lower high major trend reversal. And had I bought here, I probably would have exited here. I might have reversed to short, I don't know, but I probably would have exited here because I would have questioned my premise. Strong bear breakout with bear follow through, If I had not exited earlier, I would have exited here. I would not have waited for my stop to be hit down here. Because once I believe the market is always in short, then clearly my premise is wrong. And why wait for my stop to be hit if I now believe it's always in short? If I believe it's always in short, I believe it's going lower. So usually when you have a stop that's far away, it does not get hit because you exit before it gets hit. Something will happen that makes you question your premise. High 2 and low 2 setups, a high 2 bull flag, a low 2 bear flag. Why do they work? It's because of counter trend traders. Let's say you have a bull trend and then bears short and the market goes up, forming a high 1. And let's say they short again, right? So it's going down twice. If it goes up a second time, most bears will give up and they'll buy back their shorts, right? So they'll buy, and that is exactly where bulls are buying to go long, because you had 2 pushes down. If the market goes up, it's a high 2 buy setup. And so the bears are buying to get out of shorts. The bulls look at it as a high probability with trend setup and they're buying. So everybody's buying, and that makes it a very reliable buy signal. Okay? If you're trading counter trend, trying to pick a top, you might let the market go against you one time. So let's say your market's going up and you short below a bear bar. You might let it push up one more time. If it comes down your way again, you will not let it go up a second time. And that's why a high 2 is such a reliable buy signal. The bears are getting out and they won't look to short again for a while, and the bulls are getting in. So counter trend traders usually do not let the market go against them twice. They give up and they decide that the trend is trying to resume, and they just get out of their counter trend trade. For example, in a bull, a high 2 is the second attempt for the bull to resume, and if traders are short, they'll buy to exit. If traders are flat, they'll buy to get long. So you have the bears buying and the bulls buying, so the market probably is going higher. And that's why traders should get out of a high 2 if they're short, and why a high 2 is such a reliable buy signal. Everybody's buying. The bears are buying and the bulls are buying. There's nobody left to sell. If everybody's buying, the market has to go up to find sellers, and that makes a high 2 a reliable buy signal in a bull trend. Okay? It's even stronger if the signal bar for the high 2 setup is a strong bull bar, a signal bar closing on its high. That makes it even a higher probability trade. Let's say you have a bear trend and you have a low 2 sell setup. It's a second attempt for the bear to resume. That makes it a higher probability trade. If traders were bottom picking, they'll get out. They will not let the bears try to resume the bear trend twice, right? There's too much probability that the bears will succeed. So the bulls who bought what they hoped would be a bottom are going to sell. The bears, if they're flat or if they're already short, they're going to sell to add to their shorts or to get short. So you get the bulls selling and the bears selling, and the market will probably go down, and that makes a low 2 short in a bear trend a very good trade. With both the bulls and bears selling, nobody's willing to buy at that price. The market has to go down to find a price where traders would be willing to buy. Okay? It's a stronger setup if the signal bar for the low 2 short is a bear reversal bar closing on its low, especially if it's at the moving average and the close of the bar is below the moving average. So here's an example. We have a gap down and a bear spike, and we're trending down. Bulls might look at this as a second entry long, a good looking bull bar closing on its high, and they're pretty confident they may not exit below this this bar. Bears might look at this and say, oh, that's not a great bar for the bears. I have a good looking long. I'm going to hold long with a stop below my signal bar. The market starts to resume up again, and now we have a low 2 sell setup, and this one is a bear bar closing on its low. These bulls who bought hoping to be picking the bottom, they'll let the market go against them one time here with the low 1. They're going to get out on the low 2. So most of the bulls who bought here will not wait for their stop to get hit down here. they'll simply get out below here. And the bears will short here for a scalp. It's a high probability trade. High probability tells you that the move probably will not go very far, right? High probability usually means small reward and therefore a scalp. And this went down far enough for a scalp. It turned out that this was a final flag and it led to the low of the day, but there was enough room for a scalp. A trailing stop, you have to keep adjusting your stop as the market goes your way because you want to keep your risk from getting too big. So let's talk about a strong bull trend. Every time the market goes up to a new high, if it goes above a prior high, you should be thinking about tightening your stop. So you raise your protective stop, you trail your stop, and you put it up to below the most recent higher low. Remember, if the bull trend is valid and it's continuing, it should continue to form higher highs and lows. So if the market goes below a prior low, it's probably now in a trading range and no longer in a bull trend. And if you're swinging based on the premise that it's a bull trend, you don't want to continue to hold that premise when now you're clearly wrong. So after every time the market makes a new high, the traders who are swinging longs usually raise their stop to just below the most recent higher low. Okay? If that recent higher low is too far below and the market is racing up, traders won't risk all the way to below its low. Instead, they'll look at the most recent very strong bull trend bar and place their stop below that, or they'll look for some other support level like a trend line and put a stop several ticks below that, or they'll simply use a money stop like 20 ticks below the most recent high in the trend. At some point they'll move their stop to break even. If the trend goes very far in their direction, their stop will be much higher than break even, so even if their stop is hit, they'll end up exiting with a profit. Here's an example, a very strong bull trend. Let's say the traders bought above this bar, or if they bought anywhere in here for any reason. Once the market went above the old bull high, traders would raise their stop to below the most recent higher low here. So their initial stop was down here at the bottom of the bull spike, or somewhere in here. Now that we have a new high, they'll raise their stop to below the most recent higher low. Once the market went up over here to a new high, they may tighten their stop to below this most recent higher low. Here, the market's transitioning into a trading range. It's no longer a bull trend, so traders will not use a stop this far down. They might, swing traders might, for a very small position. A lot of traders probably would see this as a trading range. They could also see it as a higher high major trend reversal, and most traders would go flat because the premise that it's a strong bull trend is no longer valid. It's either a trading range or it's a weak bull trend, a broad channel. So once the market evolves into a trading range, you trade it like a trading range. You buy low, you sell high, and you scalp. And you do not use trend stops. You don't want to have very wide stops in a trading range. When I'm talking about buy low, sell high, and scalp, selling high, it can simply be selling out of longs. It does not have to be selling into shorts. For example, it could be exiting longs on any reasonable sell signal. So if you're in a trading range and you're long from lower down, and now you have a sell signal, you don't have to go short, but you should sell out of your longs. Very few traders like to reverse, and very few traders do it successfully. So if you're long and the market gives a sell signal, most traders will use the sell signal to sell out of their longs and not reverse to short. Also, if the market is still always in long, if you have a sell signal, it's only a scalp. So there's not much profit compared to the risk. And it's not necessarily all that compelling to take that short. In general, if the trend is still always in long, it's better off only to look for buy signals and not take the sell signals unless the sell signals are especially strong. Why not reverse to short? One of the reasons is most traders find it hard to be objective. So they're holding along for a lot of bars and it's going up and they're making a lot of money. It's hard for them to argue the bull case and at the same time objectively evaluate the bear case. You know, it's hard to do two things at once. It's hard to exit along and to go short. Most traders prefer to get out of the long and then look to go short, 2, 3, or 4 bars later. It's very easy to make mistakes on your orders if you're trying to reverse as well. So, for example, if you're long anywhere from down in here in a strong bull trend, and you see this, it's probably good to go to exit your long because it's a possible major trend reversal, higher high major trend reversal, now a double top bear flag. So it's a possible lower high major trend reversal, right? So I definitely would get out of longs. Most traders would find it difficult to reverse to short. Again, once the market evolves into a trading range, don't use swing stops. So you don't want your stop way down here or even down here. Now that the market's a trading range, you have to trade it like a trading range, and you use trading range stops. You want to be exiting in the top half of the trading range. You don't want to be exiting, way down low. Okay, what about when the market's in a bull channel, a strong bull channel, very tight bull channel? Let's say you bought here. You bought the close of a strong bull bar after a breakout of a high 2. You could use a tight stop, one tick below your entry bar, or you could use a wider stop below the most recent higher low. Okay? If you're using a wider stop, you have to be trading smaller. If you're using a tighter stop, you could be trading a bigger size position because you want to keep the total dollars at risk the same. You don't want to exceed your comfort zone. The wider the stop, the higher probability of success, but the more ticks you lose if the stop is hit. Let's say you bought up here at the top of this bull bar thinking that this is an extremely strong bull trend day and you are confident it's going to go higher. And that is a reasonable assumption, and it is reasonable to buy up here. You might want to put a tight protective stop right below the low of the very big bull bar, or you might think, it could be a buy climax, we could have a bigger pullback. I'm going to risk to below the most recent higher low and put your stop down here. Risk is greater. It's a valid decision, but if you're using a bigger risk, you have to trade smaller to keep the total dollars at risk the same. Another example, the trend is resuming. We have an outside up bar. Let's say you bought somewhere here above the high of this bull bar. Okay? As soon as the entry bar closes, you could use a very tight stop, one tick below its low, or a wider stop below the low of the outside up bar, a smaller, most recent higher low. Again, the wider the stop, the higher the probability of success. Okay, here's that same bull trend day, and look what happened over here in the green box. Is it still a strong bull trend? No, it's the bull channel has now evolved into a trading range, so you should be trading it like a trading range. You should buy low, sell high, and scalp, and no longer use wide swing stops because it's no longer a bull trend. Break-even stop. Let's say you buy in a bull trend, a lot of traders will see the market go up a little bit, and they'll allow it to come back to their entry price one time, and they'll continue to rely on their initial stop. But once the trend resumes again, they'll move their stop to break even. They will not let the market go their way twice and come back to their entry price a second time. And that is a correct way to trade. A lot of times the market will come back a second time to the entry price but not quite get there. It'll miss it by one tick and then it will resume your way again. That is a sign of a strong bull. Okay? The bears tried to hit that stop and they came to within a tick, but the bulls overwhelmed the bears at that moment, and that's a sign of strength. And if the market starts to turn up again, they'll buy above the high of that test bar. That test is a breakout test. It's a test of your original breakout, and traders will buy on a stop one tick above the high of that bar. That's a reliable second signal in your trend. Here we have a bear trend, a pretty good trend line break, and a potential lower low major trend reversal. A bull inside bar at the new low. Traders will buy above its high, looking for a swing up. Not a high probability trade. Most major trend reversals have 40 to 50% chance of success, but because the reward is so big compared to the risk, it's a good trade to take. So let's say you bought with this blue arrow one tick above the high of this signal bar, and the market goes up a little bit and it comes down, and it would have hit your protective stop exactly to the tick, right? Okay, it's a breakout test. Most traders would stay long. A lot of traders would say, it's reversing up from the entry price with a decent bull bar, I'll buy more. Okay, or if they took a scalper's profit here, so now they have a smaller position, they'll put their full position back again as the market reverses above this bull reversal bar. Okay, the market's starting to go up again. Look what happened here. Okay, the market resumed up. Okay, and it came down again, but this time it missed the break-even stop. This red line is the entry price, right? So the market came down to their entry price once here, right? It hit their entry price. They stay long. The market started to resume again. A lot of traders will put their stop now at break-even, and look what happened here. The market came down to within their break-even price repeatedly and never hit their price. That's a sign of strength. So if the market starts to go up again, traders will go long. They'll place a buy stop one tick above the high of the most recent bar, and they'll go long here. So if they scalped out part here or here, they'll put back their full position over here on the perfect breakout test. It missed the break-even stop by a tick. You want a reward at least as big as your risk at all times. Once you determine your stop size, then you can decide on your risk. Market's in a trading range. Very strong bear reversal bar at the moving average. Probably will work. Therefore, probably means probability at least 60%. So therefore, you can go for a reward equal to your risk. You place a sell stop one tick below the bar. You get filled right here at this red line on this bar. You know your stop is one tick above your signal bar. You need to exit with a risk of at least as many ticks as, with a reward of at least as many ticks as you're willing to risk. So here's your initial stop. Here's your entry price. A measured move down is here. You also could have adjusted your risk based on actual risk, right? After this strong bear bar, traders would look back and say, well, my actual risk is one tick above the high of this bear bar, and therefore go for a reward equal to the risk, and they would have been filled somewhere over here. Okay, we have a higher low major trend reversal. You can either buy above the bear bar or above the bull bar. Let's say you bought above the bear bar. Your initial protective stop is here. Your minimum target is a measured move up. So if you're looking at this as a scalp in a trading range, you'll probably be successful. If you're looking at it as a swing, you want to go for a reward equal to twice your risk, which would be somewhere up here, and you would have been filled on this bar. Okay, I mentioned in an earlier module that sometimes the probability is 90%, and you actually believe that it's 90%, and you are correct. Let's say you're in a strong bull trend and you have a limit order to take profits, and the market touches your limit order and then pauses or pulls back a tick or two, okay, and your limit order is not filled, okay? You're looking for a reward of one more tick but your stop might be 6 or 7 or 8 ticks below where the market currently is. At that instant, you believe that your limit order will get filled before your stop is hit. So you believe that the market will go 1 tick higher, 1 tick above your limit order, so that your limit order will get filled, and you're willing to risk to your protective stop, which might be 6, 7, or 8 ticks away. And if you're trading rationally, you can only do that if you are 90% certain. And that actually is correct. You probably are rational to have that belief. That is a correct belief. Every time the market is approaching your profit-taking limit order, and it touches your order but does not fill it, at that instant, if you're staying long, trying to get that extra tick, you're relying on your stop, which could be 6, 7, 8 ticks away. You could only continue to hold long if you're 90% certain. And that means that many times during the day, you are 90% certain of what the market will do next. But you're 90% certain it'll go 1 tick while risking 6 or 7 or 8 ticks. So to have that kind of probability, because of the trader's equation, it can never get too skewed one way or the other. To have that kind of a probability, you have to have a risk much greater than your reward, which in fact you have. This is the end of the module on protective stops. This is Al Brooks, and this is my price action trading course. The current module is about actual risk. Remember the trader's equation, and you only take a trade if the probability of success times the reward, your profit target, is greater than the probability of failure times your risk. And you want it to be substantially greater if you possibly can find a trade that would allow you to achieve that goal. If you know the probability and the risk, you can calculate the smallest target needed to have a positive trader's equation. In other words, to have a positive strategy, a successful strategy. You should always assume that the probability is between 40 and 60%. And to have a profitable strategy, when a trade looks good, you assume it's 60% likely of being successful. When that's the case, you need a reward at least as big as the risk to have a profitable strategy. Worst case is the probability is only 40%. And when that's the case, you need a reward at least twice as big as your risk. So if you look at a setup and you say, yeah, it's a setup, but I don't think it's going to work, then you need a reward twice as big as your risk at a minimum to have a positive trader's equation. You can make assumptions about probability. The setup is either clearly good, you look at it and you say, yeah, I think this is a good trade. When that's the case, assume you have a 60% chance of profit. If you look at it instead and say, yeah, I don't know, it might work, I think it's okay, but I'm not sure, then assume probability is 50%. If you look at it and you say, yeah, I don't know, I understand the logic behind the trade, but I think it's probably not all that good, then use 40% for the probability. The initial risk, you make assumptions about risk as well. The initial risk, most of the time, if you're buying, you'll place your protective stop below the signal bar. And that is your risk, from 1 tick above the bar where you entered and 1 tick below the bar to where your protective stop is. If you're shorting, most of the time you'll use the high of the signal bar as your protective stop, and so your initial risk is 2 ticks greater than the height of the signal bar. Your stop is 1 tick above, you enter 1 tick below. Once the trade starts to go your way, you can adjust your stop and determine what your actual risk was. So after the trade starts to go your way, just count the number of ticks you would have needed for your stop to not have been stopped out. This is your actual risk. So if the market is, if you buy here and the market starts to go up, the lowest point the market went while you were in the trade plus 1 tick is your actual risk. And what's the smallest reward for a good trade? If you know the probability and the risk, you can calculate what that reward has to be. It's the smallest reward needed to have a positive trader's equation. You still have to go for a target that's at least as big as your new smaller risk, no matter how positive no matter how certain you are that the trade will work. You can take profits at your minimum target. When in doubt, you always take profits at 2 times actual risk, and this results in a positive equation. It is also, therefore, a reasonable minimum reward. So when you're not sure where to take profits, go for 2 times your actual risk. That's a reasonable minimum. You should always go for a target that is at least as big as the new smaller risk, your actual risk. And another rational minimum that you have to consider is maybe 1 point in the E-mini or 10 ticks in a stock. You don't want to go for targets less than that because commissions become a problem, slippage and execution issues become a problem. For example, let's say you went for a 2-tick scalp in the E-mini. If the commission is $5 for a round-turn trade, then each winner is $25 minus the $5 commission, so you net $20. Each loser, you lose $25 plus you pay the $5 commission, so it costs you $30. And that's assuming you execute everything perfectly, don't make any mistakes in your decisions, in other words, taking bad trades, and you don't have any slippage. So if you take 10 trades and you win 60% of the time, you'll win $20 60% of the time and have $120 profit. You'll lose 4 trades times $30, and you'll lose $120. So after 10 trades, winning 60% of the time, you won't have any profit. And that's being 60% right. And therefore, if you're going for 2 ticks profit, you have to be right 80 to 90% of the time to make a living. And that's simply unrealistic. You need a positive trader's equation if you're going to make a living doing this. If you're taking a trade where the trader's equation is negative, you will lose money. And your target has to be big enough so that commissions are not too big compared to the profit. In general, you prefer to have commissions be maybe 5% of your profit. So if you're spending $5 round turn in the E-mini, you need to make maybe $100. You can make money on a 1-point profit target if the probability is high enough. Most traders should not be going for 1-point scalps in the E-mini. They should be going for 2-point scalps at a minimum. When 2 times the initial risk is too big, this is common in trading ranges. Then you have to reduce the target to 2 times the actual risk. So instead of using the initial risk, take a look at the actual risk and change your target. And if the probability is high enough, you can even exit at 1 times the actual risk. But for most traders, that I think is unrealistic. I think it's very difficult to make a living doing that unless you're an experienced trader. And even then, you have to make decisions very quickly. And you have to do it day in, day out, year after year. And I think that's beyond what most traders are willing to do. You can do it for short periods of time, but to try to do it for a career, I think it's too much. I think it's too much to expect most people to be willing to do that. Let's go through an example in the E-mini. Okay, at this point in the day, the market's been in a trading range. It tried to get above the high, turned down, went below the low, turned up, went above the high, turned down. It's now below the low and it's trying to turn up. And the move down had a bear bar, dojis, bear bar, bull bar, bear bar, bull bar. So trading range behavior. No series of bear bars. So the market probably will try to turn up here or soon. You see a very good looking bull reversal bar. 3 pushes down, 1, 2, 3, or you could argue it's a high 2. There's a high 1 triggering above this bar, or you could say this is a strong first leg down, and then we have another leg down. It doesn't matter. If you call it a high 2, a high 3, it doesn't matter. What you see is a strong bull reversal bar, new low of the day on a trading range day. The decision is whether or not this bull bar is strong enough to reverse this bear breakout bar. You might decide to wait for a second signal, and in fact you would have gotten one here, but at this moment you would not know that. Alternatively, you could simply buy one tick above the high of this signal bar and use a wide stop, maybe a measured move down here. And if you did, you would not have been stopped out when the market went below your original signal bar. So at this point, the market goes below your signal bar. Many traders would buy more right here if they were not stopped out. If they were stopped out, they would buy anyway. So this is a fairly high probability buy signal. It's the second reversal from a new low of the day on a trading range day, and both signal bars were strong. So this is, I think, a highly probable trade. So you'd look at it and you say, okay, 60% certain that if we get above this bar, we'll go up at least equal to my risk. But what is your risk? Your initial stop was down here. It's unlikely you're going to get one time your initial risk, because that would be way above the high of a quiet trading range day. On the other hand, as this bar is forming, when the market's up here somewhere, you'd say, okay, this is a bull breakout, a good-looking entry bar. So I'm not going to use my initial stop down here. I'm going to move my stop up to one tick below the low of the second signal bar. So your actual risk, had you bought above this bar and went long right here, your actual risk is from that entry price down to one tick below this second signal bar. 1 times that actual risk is up here. Remember, when you looked at the trade, the second entry, at this point you said, yeah, I think it's a good trade. I think it's probably going to work. Even though you entered over here and not over here. At this point, there's a 60% chance that the market will go up probably 1 times the risk of an entry above this bar, maybe 1 times the risk of an entry above this bar. So you could take a measured move up. Let's use your original entry right here. And now you know your actual risk was right here. 1 times that level is right here. So you could place a profit-taking limit order to exit your long for a scalp at this level, and you would have been filled. So if you bought over here, you take profits over here at 1 times the risk. Most traders should not be going for 1 time the risk, but this is, I think, a high probability trade, especially when it turned up the second time. And had you decided that you were going to take the trade, given that the probability was high that you would be successful, you could get out at 1 times your risk. The actual risk, not the initial risk. The initial risk was all the way down here. Here's your entry price. So the initial risk was from your entry price all the way down there. What happens when the actual risk is actually very small? Don't adjust your target based on the actual risk, because it'll be too small for the market conditions. You have to use some other method to determine where you should begin taking partial profits. One is you could go for a partial profit based upon your initial risk. If the probability is high, maybe 1 times the initial risk and start taking profits. If the probability is high and the trade looks really strong, you'll want to exit with more than just 1 times the initial risk, maybe 2 times the initial risk, or maybe exit based upon some support or resistance. If you're shorting and it looks like a very strong setup and the support is way down here, and that's 3 or 4 times your initial risk, that's a reasonable location to take your profit. So you're basing it not on the initial risk, not on the actual risk, you're basing it upon the price action. Here's an example. A very strong bull breakout, a gap up, very strong first bar of the day, very strong second bar of the day, strong bear bar, but we couldn't even trigger a pullback. So we have a strong bull inside bar closing on its high tick. You get filled on this bar 1 tick above the high of the signal bar, and then the next bar of the market went up. Your actual risk, let's say we're at this point and you're looking at actual risk, it's only right here. So your actual risk is from your entry price to 1 tick below the entry bar. 2 times your actual risk is right here. It's not even at a new high of the day, right? When you see a huge breakout like this, you know that the odds are probably 60 or 70% that the market will go up to a measured move based on the height of the spike. From the open of this bar to the close of this bar. So somewhere up in here. Probably 60, 70% chance the market will get there. And if that's the case, you certainly don't want to be exiting at 2 times your actual risk right here. So you have to use some other logic to find a place to begin to take profits. You could, here's your 2 times actual risk. Do not exit there. But if you use the body, the open of the first bar of the spike to the close of the second bar of the spike, you can come up with a projection up here and take half off, for example, at 1 times that height of the spike. When the market is racing up like this, you might decide, well, it's racing, I'm going to let it run. I'll wait until I see any kind of a reversal. You could look at this and say, okay, we've had 3 pushes up here. Yes, it's not a wedge that is worth shorting. The market is almost certainly going higher, but it may pull back fairly deeply. It may pull back all the way down here, and I don't want it to come back that far. I don't want to give back that much profit. So I'll take half off either on the close of this strong bear reversal bar or right below its low. And you'll end up with a profit target that's much greater than your actual risk, and that certainly makes sense. You could say your initial risk was below the low of the bull spike, and you could have used a measured move based on your initial risk, which would be slightly more than this red line, somewhere up in here. That's okay. The key thing is don't base it on your actual risk. If your initial risk was below the signal bar, 2 times that risk is still too small, and I think that would not be a good location for an exit. That probably would have been right up here. So if you put your initial stop here, your signal's here, 2 times your initial target was right here, and you can see some profit taking took place. The market went sideways. But after this bull spike, I personally would like to go for a much bigger target. What happens when the actual risk is actually very small? Don't adjust your target based on the actual risk, because it'll be too small for the market conditions. You have to use some other method to determine where you should begin taking partial profits. One is you could go for a partial profit based upon your initial risk. If the probability is high, maybe 1 times the initial risk and start taking profits. If the probability is high and the trade looks really strong, you'll want to exit with more than just 1 times the initial risk, maybe 2 times the initial risk, or maybe exit based upon some support or resistance. If you're shorting and it looks like a very strong setup and the support is way down here, and that's 3 or 4 times your initial risk, that's a reasonable location to take your profit. So you're basing it not on the initial risk, not on the actual risk, you're basing it upon the price action. Here's another example where the actual risk is small, but instead of in a breakout, this is in a reversal. The market's trying to put in a bottom, a trending trading range day, an upper range, a lower range. You can argue final flag here, possible final flag here. In any case, you have a small bull signal bar for your setup, and if you bought 1 tick above the high of this signal bar, your initial stop might be below its low. 2 times your initial risk would have been right around here or so, and that's probably still too small a profit target given the way this market looks. The market probably will try to test one of these highs, maybe the low of the upper trading range. Your actual risk, you'd know it when the market started to go up. So maybe on this bar as it's going up, certainly by the close of this bar, you could calculate your actual risk, right? And your actual risk is from the low of your entry bar and to 1 tick above your signal bar. Had you had a stop at that price, you would not know this in advance, but had you had a stop at this price at the time you entered, the market would have missed your stop by 1 tick and then rallied. So in hindsight, you'd know that your actual risk was very small right here. And as this bar was forming, if you exited at 2 times your actual risk, you would have gotten out right here. And to me, that's unrealistic given this market, the bars to the left. The market probably is going to rally to the top of this lower range at a minimum, the bottom of the upper range. It may break into the upper range again. So you cannot use your actual risk as the basis for taking partial profits. Even your initial risk, I think, is too small because the signal bar is so tiny. So you should use some other method to determine where you should take profits. One would be to start selling at obvious resistance areas, at these swing highs. You can see some traders did that. That's what caused this tail. So they placed limit orders to sell maybe at this high and that high. And when the market got there, those bulls took partial profits, maybe half off, and that caused this pullback. Also, they may have taken profits at the moving average or above the moving average, and that could have caused this pullback. So, bottom line, when the initial risk or the actual risk are too small, you should not use them to determine where to take profits. Instead of going for 2 times your risk, actual or initial, use something else like resistance above. Sometimes you'll have very strong trends, let's say a strong bull trend, and you'll see a high 1 setup, but there'll be something that's not right about the setup. Maybe there was a 1 bar final flag before. Maybe the signal bar is a small doji bar, and you wonder if the market is starting to form a tight trading range. The same is true in a bear trend. Sometimes you'll see a low 1 in a strong bear trend, and it sometimes doesn't look quite good enough. So in a bull trend, sometimes there's a weak high 1 buy setup, and a strong bear trend, sometimes there's a weak low 1 sell setup. When that's the case, you can sometimes use your actual risk to set a profit target. If the setup is not really clear, set your target at 2 times the actual risk. You remember, you're thinking it's a weak setup and the market might be transitioning into a trading range or a tight trading range. So you're going to be quick to take profits if it does not resume another breakout. Here's an example of a strong bull trend and a strong high 1 buy setup. This is the example I showed a few minutes ago. Extremely strong bull breakout. Here's a high 1 buy. I would not be quick to take profits. I would assume that this is going to run, so I would swing most of that. The market is still breaking out and still very strong, and 2 bear bars, but to me, I would not be scalping for 1 point. I would let this go and see where it goes. And even if it pulled back, I would let it pull back and rely on a stop, maybe below this bull bar, the most recent big bull bar, or the most recent higher low, which probably would be that. And I would let that go. Here, it's not nearly as strong. We have a very strong bull spike, but it's the 3rd push up, and we have bars that are getting bigger and suddenly a very big bar. This could be a buy climax and the start of a trading range or a pullback. So this is a weaker high 1 buy setup. I think you can still buy it, but management is tricky, and I probably would try to go for 2 times actual risk. So actual risk might be 1 tick below the signal bar, 1 tick above, and then 2 times that would be right around here. And it looks like a lot of traders did exactly that. When you have a strong bull trend but a weak high 1 buy setup, life becomes much more difficult. You have to decide what to do. Here we have a bottom and an extremely strong bull breakout, and now the bars are even getting bigger. These last 2 bars are extremely big, but look where they're going. They're going right up to a prior high, a high from the day before. So it might simply be a buy vacuum testing yesterday's high, and therefore a buy climax, and there might not be more follow-through. If this bar closed way up here, then I would say, yeah, we broke way above these bars, and I'd be much more inclined to buy a high 1 up here. But when the market just races up here and goes a tick or 2 above a resistance level, and then has a tail, and then the next bar is a doji bar, a small doji bar, to me, yes, it's a high 1, but it could be simply a buy climax that's testing resistance. This could simply be a buy vacuum getting sucked up to resistance, and then profit takers will come in. So to me, this is a weak high 1 buy, and it's tricky to manage it. Can you buy it? Absolutely, you can buy it. But if you buy that, you initially have to rely on a swing stop, maybe below the low of the 2 bar spike. And if I were you, I would trade small and look to add on at a location where traders might have protective stops. Traders might have stops below the low of the bar. So that would be a good place to add on and maybe risk 2 or 3 times that, or keep your initial stop down here. But then I would also be thinking about, if the market does not go my way quickly, getting out at break even. Alright, so here the market went up again, but quickly turned down in a 2 bar reversal. It went 1 tick below. Okay, so at this point, I would be hoping that the market comes back up high enough so that I can get out break even. At this point, after this strong bear bar, I probably would not be trying to get out around my original entry price, 1 tick above the high of that bar. I probably would look at my entry price, look at my add-on, and try to look to get out around the midpoint and I probably would have gotten out around here at break even. So even though there's a very strong bull move, there's a weak high one buy signal bar, and it's at resistance. In general, I don't want to buy high ones after buy climaxes, and I certainly don't want to buy high ones right below resistance after a buy climax. But had I bought that, I would have managed it similar to what I just said. So just seeing a high one after an extremely strong bull move is not reason enough to buy. Here's a high one in a bull trend, and the probability is good. And when the probability is good, you can exit at 1 times your actual risk. You might call, let's say you bought above this bar, right? It's a high one, a bull trend, no obvious resistance to the left. There might be some measured move targets up there, but I don't see any really strong obvious resistance like a trend line or a trend channel line. So to me, that's a reasonable high one buy. The market triggered, but immediately reversed down. And if you bought it, you could manage it like the prior trade. Keep an initial stop below the big 2-bar bull spike, and then see what happens. Okay, at this point, the market probably didn't fall low enough for you to buy more. This is a 15-minute spider chart, by the way. Just to mention that you can use price action on any kind of a chart, any time frame. All right, so once the market started to turn up a second time, then we have a high 2 buy. Right, you bought the high 1, but now it's triggering a high 2, and that in a bull trend, that's a higher probability bet. There's a double bottom. This doji bottom, it went up and then down again. So at this point, as the market goes above this buy, you realize that the probability is high that the trade will be successful. At that point, you can say, okay, high probability, I can exit 1 times risk. We're getting dojis here. We might be entering a tight trading range, so I don't need to hold for 2 times risk since the probability is high. So at that point, you could try to scalp out for 1 times the risk and take profits right here. A lot of traders, if they did not buy the first time, they would have bought the second time because it's a high 2. Many traders who bought the high 1, if they see a second signal, they'll buy more. And since the second signal is higher probability, they could exit for a scalp at 1 point. Here's a bear trend, a strong bear trend. You can argue, well, Al, it's really a channel, and therefore it's not a strong bear. At this point, it is a strong bear. We have a breakout, and here's a low 1 short. And it's a pretty good low 1. This is a strong low 1 short. I think that's a very good one to take. However, look at this one right here. Okay? This could be a 1-bar final flag. We have a possible reversal here. And then we have this signal bar here. This very small bar is a signal bar, and it's a doji. So we have a doji here, and small bars here. The market might be evolving into a tight trading range. So to me, that's a weak sell setup. If you took it and you were thinking, okay, it's a bear trend, I'm going to short anything for any reason, you probably would be using a swing stop, which would be maybe up here or maybe even up here. And at the moment you took the trade, your stop is somewhere here or here. And then you have to decide what to do. At some point, you decide in here that, yeah, the trend is resuming. So maybe with 4 consecutive bear bars, even though they're small, you might decide, okay, I think the trend is going down. And at that point, you know that your stop is going to be above this high, your new stop, and your actual risk was from the entry price, 1 tick below the low of that bar, to 1 tick above the high of this bar. And the probability is good at this point. Here's another weak low one, but let me deal with this one right now. Okay, so as the market is going down 3, 4, 5 bars, you believe the trend is resuming, so you know your actual risk is right here. And you could either take part off at 1 times actual risk, or you could go 2 times actual risk. If you think, well, maybe the probability is 50-50, then go for 2 times actual risk. Here's a similar situation. If you shorted this low 1 below 2 bull bars after consecutive sell climaxes, sell climax here, sell climax here, sell climax here, and the market might be starting to correct. Initial stop above the spike. Okay. Once the market started to turn down, here all you need is 1 or 2 big bear bars to believe the market is resuming. You'd move the stop from above the most recent higher high or the top of this new bear spike to above this lower high. I said higher high, I meant lower high. Anyway, as the market's resuming down here, you tighten your stop over to here, and you could calculate your actual risk. And your actual risk was from your entry price, one tick below this bull bar, to one tick above this lower high. And you could say, okay, when I took the trade, I'm not all that certain. When I'm shorting here, I'm not all that certain. I could go for 1 times risk and be happy to get out. Or I could say, mathematically, I took a lower probability trade. I should go for 2 times risk. It's a strong bear trend day. I don't want to take profits too soon. Maybe I'll take profits at 2 times risk. And you can see what happened when it reached the 2 times risk area. There was a pullback. So you were not alone in taking profits in that area. That is the end of my module on actual risk. This is Al Brooks, and this is my price action trading course. The current module has to do with protective stops for scalping. Remember, a scalp means a small profit target, and usually traders don't allow pullbacks, except maybe a small pullback. To take a scalp trade, the trader's equation still must be positive. If you're going for a small profit, you need a high probability trade. The cardinal rule of all trading is to make sure that the reward is at least as big as the risk, even with a scalp. A scalp requires a high probability setup, and you can use a stop that is no bigger than your goal. And also, once you figure out what your stop has to be, you have to make sure that your goal is at least as big as your stop. Once the market gets close to your target, most traders move the stop to break even. For example, let's say the market's within a tick or two of hitting your profit target, and your stop is now 10 ticks away. Most traders will not allow that to happen. They'll move their stop to break even, and if they get stopped out, they don't worry about it. So to risk 10 ticks to make 2 ticks, you have to be 90% certain of it happening, which in general is unlikely. And if you're less certain than 90%, the trader's equation would be negative and you'd lose money. So once the market gets within 2 or 3 ticks of the target, let's say you're risking 10 ticks, if the market comes to within 2 ticks of the target, most traders would start thinking about moving their protective stop to break even. For stops, traders can use a money stop. For example, let's say they're buying IBM, they might risk $1, a fixed number of ticks. Or they can use a price action stop based upon the price action. So let's say they sell below a strong bear signal bar, they may place a protective stop 1 tick above the high of the bar. So for a money stop and a bear trend, you want to risk a certain number of ticks or points above your entry price. So for a small stock, a small price stock like Cisco, Bank of America, maybe you want to risk 10 or 20 cents from your entry price. And the E-mini, with the E-mini trading around, let's say 1400 or so, and the average daily range of about 10 points or so, you might want to risk 2 points. If you do choose to use a 2-point stop in the E-mini, you need to go for a profit target that's at least 2 points, even in a scalp. You always want your profit goal to be at least as big as your risk. If you're trading a $100 stock and you're using a 50 cents stop, you have to go for a profit target of at least 50 cents, at least as big as your risk. And what about a price action stop based upon the bars? Okay, that's what a price action stop is. You base it on what's going on with the chart. For example, if you're buying in a bull and you have a bull reversal bar for your signal bar, you would consider placing a stop on 1 tick below the signal, 1 tick below the low of the signal bar. You may also use a measured move target, based upon either the height of the signal bar or some gap above the signal bar. Most traders do not do that. Most traders would use a price action stop based upon the signal bar, not based upon a measured move. So most traders either use a fixed stop a number of ticks away, or they'll base their stop on the signal bar. Let's say the signal bar is 8 ticks tall. The risk is 10 ticks, right? If you bought 1 tick above the top of the signal bar, okay, and you risked to 1 tick below the signal bar, the total risk is 10 ticks. And then you should go for a profit target of about 10 ticks. You always want your reward at least as big as your stop. So if your risk is 10 ticks, you go for at least 10 ticks of profit. And if you're using a wide stop based on a measured move, you have to use a wider profit target at least as big as your risk. Here's an example of a money stop for scalpers. Let's say the traders bought the close of this bar. At this point, the market, in the minds of most traders, is always in long. They might use a money stop 2 points below. If they did, their minimum target would be a move equal to their stop, which would be right here. Let's talk about the same trade, and this time, let's say traders bought this close, and they used to stop at 1 tick below their entry bar. This is the bar that made the market always in long. It's a breakout above the high of the day, and well above this high. The close of the bar is above the high of the day, and way above the high of the prior bar. So traders might put a stop below the low of the bar. If they did that, again, they need a reward at least as big as their risk, so they would go for a profit target up here. And you can see that the market went sideways up here, so a lot of traders did, in fact, take profits at around that measured move target. Okay, once the market gets close to your goal, if you're scalping, you want to move your stop to break even. So if it gets to within 10 or 20% of your target, you'd move your stop to break even. Okay, you want the reward at least as big as your risk, and once you determine your stop, you make sure to go for a reward equal to your stop. So if we have this strong bear reversal bar here, and you shorted at the moving average in this bear trend or trading range, at the moment it's both a bear trend forming lower lows and highs, and it's also a trading range. So if you shorted this bear bar at the moving average, your initial stop is above its high, and you entered right here, you could go for a risk equal to its reward. After you had this very strong bear bar, you could then go back and look at your actual risk, which was 1 tick above the high of this bar, and you could adjust your target based on your actual risk. So your actual risk now at the end of this bear bar is up here. Your entry price is here. You could go for a measured move, which would be right around the close of that bear bar. So as that bear bar is forming, a lot of traders would say, oh, my actual risk is probably above the high of the bar. My reward now is equal to my actual risk. I'll take profits. And that's what happened, and that's why the market reversed up there. A lot of traders scalped out of their shorts based on their actual risk. Okay, over here, if you bought above let's say you bought above the high of this bear bar, thinking it's a higher low major trend reversal. Your initial stop is below the low of the signal bar. Your initial target would be a measured move up right here. And that is the end of the module on protective stops for scalps. This is Al Brooks, and this is my price action trading course. The current module is about scaling into trades. Scaling into a trade simply means adding to your current position, and that you're confident that the trade will go your way soon, although you're not yet confident that the market has begun to go in the direction that you anticipate it will go. For example, let's say you're in a bull trend and the market has a pullback and there is a buy signal, and you take the buy signal, but you're not sure that the correction has fully ended, but you're willing to rely on a swing stop below the bottom of the bull spike, and the market goes your way for a bar or two and then drops below your entry price and drops below the low of your signal bar. Since your stop is below the bottom of the spike, probably several points below where you are now if you're trading in the E-mini, you're still holding long because you believe that your premise is correct, that the bull trend is intact. What you can do is, if there's another signal, for example, let's say it occurs at a lower price, you get another bull reversal bar, you can add to your position, and that is a form of scaling into a trend that is going against you. The pullback is a bear trend within a larger bull trend, and you're adding to a losing position, but you're confident that your original premise is correct, that the bull trend is intact. Another way to scale in is when a trend is already going your way. For example, if you're in a strong bear trend and you took partial profits and you're continuing to swing part of your trade and the market pulls back and gives maybe a low to short signal, you can add to your position. You took profits on part of your trade, you still are holding part for a swing, and now you have a new signal. Perhaps you'll want to put your scalp position back on. And then when the bear resumes, you scalp out of the scalp part and you continue to swing on the swing portion. So when you added that scalp portion, you were already profitable on your swing portion, and you just were going for an additional scalp. And then if the market continues to fall and you get another sell signal, you're still holding your swing portion, and you can again put your scalp position back on. If you are going to do this, you have to keep the total dollars at risk the same as for all trades. So you need two things. You need to trade very small, and you need a wide stop. Scaling into a trade is not for beginners, and only traders who are consistently profitable should consider adding it to their trading methodology. Scaling in involves additional decisions, and trading is complicated enough without making it more complicated by scaling in, and it's something that I think most traders should not consider. Beginners need to keep their trade management simple. They should have simple rules and simple plans, and have as few decisions to make as possible, especially once they're in the trade. As an example, I'm going to talk about a pullback in a bull trend. There are many ways to scale in as the pullback continues to grow. One reasonable approach is, when you're thinking about entering, first determine where the swing stop should be. Let's say you normally use a swing stop, let's say you normally use a stop of 20 cents in the spider, and you determine that the swing stop is 40 cents from where you're thinking that you want to enter. So you see a buy setup, but the swing stop is 40 cents below. What you should do is trade a quarter size for your first entry. If you are not scaling in and your stop size is double, you would trade 1/2 size, because then if you get stopped out, you lose your normal maximum amount. On the other hand, here you're going to be willing to risk to that to that swing stop 40 cents away. If you trade half size and then add on lower, your risk is greater than normal. So you should start with a very small position, like a quarter of your normal position size. So if you normally trade, let's say, 400 spider shares, and you determine that your stop has to be twice what you normally use, you would trade 100 shares for your first entry, and then look to add another 100 as the market goes further against you, and exit the entire 200 at your swing stop, 40 cents from your first entry. If your premise is still valid and the market continues to fall, but it's still above your swing stop, you can buy that second quarter add a limit order at 50% down from the high. So you see where your stop has to be, which is probably the most recent high or low, and you see where the high of this current leg is. The market's pulling back from that. You can add a second quarter. In other words, if you normally buy 100 spiders, you would buy another 100 spiders at 50% down from the high, assuming again that your premise is still valid. An alternative to buying a 50% pullback is waiting to see if the market generates a second signal. If the market pulls back a little bit further, it may have a second signal, and then buy the second quarter position, the second 100 shares, as the second signal triggers. That second signal might be below your original entry. It might be at the same price as your original entry. It may even be a little bit higher than your second entry. In either case, you exit all if the swing stop is hit, the swing stop being 40 cents below your original entry. And you also exit everything if you feel that your premise is no longer valid. For example, if you bought believing it was a bull trend and now it's converting into a trading range, and you think it may even go below your swing stop but then turn up, don't wait for it to get down there. Once you believe that your original premise is no longer valid, get out. And you certainly need to get out if you see a convincing sell signal, especially one that is strong enough to convert the market to always in short. Here's an example of a market being always in long. We had a huge gap down and a very, very strong bull bar closing on its high tick and a very strong entry bar closing on its high tick, and then another strong bar closing on its high tick. That would be a buy. We dipped below the low of this higher low, but basically formed a double bottom bull flag. So I think the market went always in long as it went above the first bar and certainly by the close of the second, and this is more evidence that it's always in long. Another bull spike, another bull spike. So I think most traders believe that the market is always in long. The most recent higher low is this low. The most recent bull spike began with this bar. So if traders were swinging along at any point after we made this new high, they would make sure that their stop was below this swing low or below this bull bar. The initial stop when they bought above this bar was below its low. And then once we went above this lower high, we have a small higher low major trend reversal. Once we went above the new high, traders would raise their stop to below the most recent swing low or below the most recent bull spike. So traders could buy for any reason all through here. They can buy the low of this bar, they can buy the bear close, they could buy above the high of this bar. Doesn't matter. If a trader were buying a swing position, they would have to see how far away their protective stop is down here and make sure to trade a position size that would allow them to be comfortable losing that amount of money. On the other hand, a swing trader would look at that and say, okay, I'm going to take this long, but if it drops down here and gives me a second signal, I'll buy more. Maybe if it reaches a 50% pullback from this low to that high, I'll just buy more in a limit order and put my stop below here. If that's the case, they cannot trade half size. They probably should trade a quarter size. So buy a quarter size maybe above this bar, and then maybe another quarter size at their add-on position, and then a stop on the entire position below. If the market just goes their way right away, that's fine. They'll have a quarter size position, and they can add on higher as other signals develop. Okay, this is what took place. Let's say the person decided not to take this buy, 2-bar reversal, thinking the breakout was strong enough, maybe we'd have a second leg down. And then they have this small outside up bar, basically a small 2-bar reversal, 2 legs down, still always in long. The market did not flip to always in short here. This bear leg is not nearly as strong as the buying pressure that we've had today. So this is a reasonable buy. Okay, a trader could take it for a swing and put a stop below here, determine how many dollars they would lose if they were wrong, and then use the appropriate position size. On the other hand, a trader might say, you know, this may have more to go. It's a fairly tight channel. Maybe we'll come all the way down here and form a double bottom. I'm going to look to add on if we get a second signal. In that case, the trader would take a smaller position size. We're already halfway down. They can determine what position size they need if they were to add on. My guess is they probably would trade maybe a third of their normal size position, maybe a quarter, maybe a half, depending on how much they normally are willing to risk. So somewhere in their quarter to a half size position. And then if it goes their way, they manage it the way they would any other swing long in a bull trend day. If it drops lower and they add on, as long as the premise remains valid, as long as they still believe it's a bull trend, they can keep their stop down here and wait. And this is what happened. The market had a second signal down here. So a large two legs down. First leg here subdivided into two parts. There's a trend channel line here, not drawn. And then a small wedge bull flag. We went up and then down and up and down and up. Or you could simply call it a low too short. But I think not strong enough to flip the market to always in short. Almost here. We're starting to get a series of bear bars. But bear bar, doji, bear bar, small bear bar. I think the selling pressure is less than we had in the rally. So it could be a trading range day, or this simply could be a big pullback in a bull trend day. The bulls will stay long as it stays above the higher low, maybe below, above the high of the strong bull leg up. So anyway, at this point, the market developed another bull inside bar, closing near its high. I think that's a reasonable long for two legs down. Traders might say, well, Al, that's a lot of selling pressure here. Let's wait for a second signal. They could have, and they got it over here. But either way, either they bought here or they bought here. They could have waited and bought here. Okay. Here we have a double bottom, bull flag. It's bull trend, always in long, so it's a double bottom, and breakout right here, and then a pullback. So this is a breakout pullback from this large bull flag, a double bottom bull flag. You could also look at this and say, it went down for about 20 bars, so it's a bear trend. Remember, all bull flags are bear trends. They're just smaller than the bull trend that preceded them, and they're so small that traders believe that they're simply pullbacks within the bull trend. So here we have a bear trend. We have a bull breakout above the top of the bear channel. I did not draw the channel line in. And now we have a pullback to a double bottom with this low. So this is a double bottom major trend reversal for the bear trend that began here, the bear flag that began here, and we're still on the, I think, the always in long that began at bar 1. So traders could buy small here, add on here, or add on here or here, and manage the trade like a swing long. When an experienced trader sees a strong trend, he's always looking to add to his position. He can, in this particular example, we have an exceptionally strong trend. He can buy early for both a swing and a scalp, and then he can scalp out whenever his profit target is reached, hold his swing, rely on his swing stop, and then add on every time he sees a new buy setup. He can add on for a scalp or for a swing. On a trend day like this is a once a month type of trend day. It's exceptionally strong. We had a huge gap up, very, very strong, two first bars of the day, and the market just raced upward with very small pullbacks. So for the first couple of hours, it was a gap up bull trend, a trend from the open bull, a spike in channel, a small pullback bull. Eventually it transitioned into a trading range. It got exhausted. However, let's say a trader took his initial full position here, and he put his swing stop below the low of his signal bar. He may have put his swing stop down below the low of the bull spike, which is the appropriate location. However, once the market had this big bull bar, the trader would have moved his stop up to below this low or below the low of the most recent big bar. Another bull breakout. So at this point, his stop probably would have been below here or maybe below here. At this point, 3 pushes up, 4 pushes up. Market's probably transitioning into a weak bull channel, a broader channel, or maybe even to a trading range. In any case, let's say that a trader bought here and then used his default, maybe taking half off at 2 times his initial risk. His initial risk below the signal bar and right here, let's say he used that for his initial risk, 2 times would be up here. So let's say he took his scalp off here and he still has his swing position on here. Maybe he scalped 2/3 or half and swung. Let's say he scalped half and is swinging half. Once he took his scalp off somewhere here and he saw another buy signal, he could put that half back on. So now he's back to a full position, and again he's going to scalp out. Maybe he'll scalp out at 20 cents in the spider. Maybe he'll scalp out at a measured move based on the height of this bar, which would have been somewhere around here. In any case, let's say he took profits around here. Another buy signal, another high 1 buy. He could put his scalp back on again. And whether he took profits up here, he probably would have exited his scalp here. He would have kept his swing, maybe with the stop below either of these bars, maybe all the way down here. Another approach for really experienced traders with deep pockets, they buy their full position here and don't exit any until they see a reasonable sell setup. So they hold the entire position up here and then take half off here. What about these additional signals? The market is so strong they could buy more here, either another full position, so now they have a double position, or maybe a half, so now they have 1.5 of their normal position. If they did that, at this point, their stop would probably be here. So if the market comes down, they would have a small profit on their original position, and they would have a bigger loss on their second position. In general, I usually don't do that. Normally, I scalp out half at some logical target. When the market is this strong, I usually do not exit at 2 times a measured move based on the height of my signal bar. What I do instead is I use the height of the spike for my first target. So open of the first bar, close of the last bar, here a 2-bar spike, measured move up. So I would take half off somewhere in this area and swing the balance. So this is adding on to a bull trend at higher prices, and you can build a very large position. Some years ago I've tried, just full position, another full position, another full position, and I would have 3 times my normal size position. My stop would be at this point somewhere down here, so even if I get stopped out, I still have a profit. But to me, I start worrying about money, so it's beyond my comfort zone, so I no longer do that. Now I take half off at my logical profit-taking location, either 2 times my initial risk, or in this exceptional case, 2 times the height of this spike. And then I keep putting the scalp part back on. A similar approach can be used for a pullback in a bear trend. Again, one reasonable approach is to determine where the swing stop should be. So you have a bear trend, and the market is starting to bounce a little bit, and starting to pull back, and you see what you think is a reasonable entry. And let's say it's an Apple, and you normally use a $2 stop in Apple. And here the stop has to be $4 away. And let's say you normally trade 400 shares of Apple. Instead of trading 400 shares and risking to $2, which is twice your normal risk, you would normally just trade 200 shares and risk to $4 if you were not scaling in. However, if you're going to scale in, remember you're going to add to your position, and that will increase your risk. So on your original position, trade a quarter size. So sell 1/4 of your position at the first signal. In other words, you sell 100 shares of Apple at the first signal. And if the trade goes your way, fine. Manage it the way you would manage a normal winning trade. If it continues to go against you, but you still believe the bear trend is intact, then add on. Again, relying on your original swing stop, which is probably the most recent lower high. You could sell the second quarter at a 50% pullback from the low, 50% of the height of the most recent leg. In other words, from the most recent lower high down to the bear low. Or you could simply wait until you see a second signal and then sell the second quarter on the second signal. and the second signal may be at a higher price. It may be at the same price. It may be at a lower price. In either case, you exit all if the swing stop is hit. You certainly exit all if the premise is no longer valid. So, for example, if you feel like the market has transitioned into a trading range or, in fact, has transitioned into a bull trend, you would exit all. Otherwise, you would continue to hold your entire position, which is 1/2 of your normal position size, until whatever profit objective has been reached. Here's an example of scaling into a bear trend. The market gapped up but then sold off and had 3 strong bear bars here. So it became always in short for most traders, certainly by this bar. For most traders, probably by this bar. There was a trading range, a breakout, and support down here at yesterday's close. Most traders would assume we're going down to test yesterday's close, and that maybe we'll get a trending trading range day, an upper trading range, a breakout, and maybe a lower trading range. Okay, to me, I think this is not a high probability short. If you take it, you may be taking a trade that has a 40 to 50% chance of success. You're taking it as a swing. Your stop is above the most recent lower high for a swing trade, so initially your stop is up here. And since it's not a highly probable trade, you're hoping to get a reward equal to twice your risk. So your risk is from the stop to your entry price, 1 tick below the signal bar. You entered right here. And then a measured move down to twice that distance, which is well below the bottom of the screen. You could convert the trade into a smaller profit based upon actual risk after entering. I talk about that in another module on actual risk. But for right now, let's assume you're going for a reward twice your risk because it's not a high probability trade. And let's say you take that short. You certainly were not happy by this close, right? You don't want it closing above the bottom of your signal bar with a big tail. Possible parabolic wedge. There's a slope across the bottom here and a steeper slope here, so it's parabolic, and it's 3 pushes down, so it's a wedge. It's possible that this is becoming the low of the day. But let's say, for argument's sake, you took the short and you're willing to sell higher, maybe on a 50% pullback with a stop up here. So if you normally trade 100 shares of the spider, maybe you shorted 100 here, planning on putting another 100 here on and exiting everything up here. But you'll also exit if your premise is no longer valid. At this point, with these 3 bull bars closing, 2 of them closing near their high, 2-bar reversal, strong breakout bar, 2-bar reversal with this bar or that bar or both. We did not quite get down to yesterday's close. We have tails on the bottoms of these 4 bars, and we have some buying pressure up here, decent bull bars and tails. The day at this point is probably back to always in long. So if you shorted here and your premise was that the market's in a bear trend and that you were going to scale in higher, maybe 50% pullback somewhere up in here, by the close of this bar, you'd have to conclude the market is always in long. So your original premise is wrong. You thought that you were in a bear trend, and now the market is always in long. So what do? Do you scale in and hope to get out, break even on the entire position, maybe exiting somewhere in the middle of your 2 prices? No, that's not what you do. You've now concluded that the market is always in long, and you're short. You can't do that. You have to get out immediately at the market. As soon as you decide that your premise is wrong and that it's now a bull trend and always in long and going higher, you have to get out at the market and take your loss. And it's as simple as that. This leg down, 3 consecutive bear bars is good. However, it's still within yesterday's range. Yesterday's range had a lot of reversals. We have many reversals going on here, and prominent tails and decent bull bodies. Certainly 3 good bull bodies here. So this is probably a bear leg within a trading range. It's possible that this is the low of the day, but a bear signal bar, that to me is not reliable. So I suspect that the day will be a trading range day. And this is how it ended up. This low one short became a 1 bar final flag. We had a parabolic sell climax, 1 bar final flag, and a reversal up, always in long. There was some follow-through buying, and there was even a second leg up. But ultimately, we went down to a new low in the day, and then reversed up again. That's what trading ranges do. They run above resistance. Remember, the swing stop for the bears was above this high, and the market went above it, only to turn back down. New low of the day, and then turn back up. And that's what trading ranges do. They run stops, they run below swing lows and reverse up. They go above swing highs and reverse down. You have to have a plan for adding on. How many times do you add on? At what intervals do you add on? What size do you add on? Do you do the same size every time, or do you trade larger positions on your subsequent entries? Okay, you can add on as the trade goes against you. You can add on as the trade goes in your direction. So for example, let's say you buy for a swing. The market goes your way. You take partial profits. It pulls back a little bit. You're still profitable, and you put back your original position. So you're adding on to your current position that is already profitable. Or let's say you're trying to pick the end of a pullback in a bull, and the market goes a little bit further against you. You're still confident that the bull trend will resume, and you add to your position at a lower price than your original trade. So you're currently holding a loss, and you're adding to a losing position. You can add on. There are different ways to do it. One is, let's say you're buying a pullback in a bull trend, and it triggers, and then the market falls below the low of your signal bar, and then forms another signal bar. So that's a second signal. You can buy there. Let's say it falls further, and you get a third signal. You can buy there. You can also add on at a fixed number of ticks. So for example, in the E-mini, you may buy, and then have a plan to buy more 1 point lower, and buy more 1 point lower again. What happens if you plan on scaling into a trade, and instead of the trade going against you, it immediately goes your way? You manage it like any other trade. And if you get your profit goal within the first few minutes, you just exit with your profit. When traders scale into trades, they can scale into reversals. For example, if they're bottom picking, they can buy. If it goes lower, they buy more. Or they can scale into trends. So if the market is falling and they're looking to short, they short, and goes against them some more, they short some more. Or they can scale into a trend that's going their way. If they short and the market continues to fall, they can short more at a lower price, building a larger position. Here's an example of scaling into a reversal. This is the daily chart, and there's increasing selling pressure. We have a strong bull trend, a reasonably strong bull trend, but now we're starting to get big bear bars. We have 4 big bear bars here, and we have 2 large bear bars here. So is the trend evolving into a trading range? I don't know, but it's certainly starting to accumulate a lot of selling pressure, and that increases the chances of the trend turning into a trading range and possibly into a bear trend. There was a strong break below the bull trend line, so traders will be thinking about the possibility of a major trend reversal when the market gets up to the prior high. Okay? So there's a bear signal bar, but we've had 7 consecutive bars without a pullback. So a bull microchannel and a bull trend, probably not a reliable sell setup. So most traders would not short below that bear bar, even though it's a double top major trend reversal. Here's that initial entry. Now, however, look what happened. We have a second strong bear bar at a slightly higher high. So this is a second entry short, and it's a second signal, and there's a strong signal bar. So this is a reasonable signal. It's a higher high major trend reversal and a second signal short. Traders might look at this and say, well, maybe we'll get one more push up, and then we'll reverse down. Maybe this will be the reversal. Some traders will simply put a buy stop above the high of their signal bar, and if they get stopped out, look for another signal. Other traders will say, well, I'm not convinced that this is the top. If it's not the top, it's pretty close. However, if it's not the top and if the trend is going to continue, it probably will continue for at least a measured move up. So let me place my stop around a measured move up. So this would be slightly above a measured move up, below the bottom of the trading range, top of the trading range. Here's a measured move up. So this would be a reasonable location for a protective stop for a trader who's looking to scale in higher. However, if a trader shorted here and was using a stop way up here and was willing to scale in more here, their initial position would have to be very, very small, like maybe a quarter or a fifth of their usual position size. So if the trader took that short and then saw this, right, the market might be breaking out to the upside and might be resuming. It looks like we're evolving into a trading range. We have a lot of selling pressure here, and then more selling pressure here and here. If this is a trading range, most trading range breakouts will fail. This is an attempt to break out. So if the bears are right that this is a major trend reversal or a trading range, this breakout should fail. And these bears who shorted down here might rely on their initial stop up here and take a chance that this breakout will fail. Some traders would simply get out above this high, and if this reverses again, short again. And this is what happened. Here's that bull breakout, and next bar opened way down here. And then we had another push up to another high, a fourth high, 1, 2, 3, 4, a bear inside bar, a bear outside bar closing on its low. So we're getting another strong bear bar after reaching a new high. This would be a reasonable sell signal. So if the traders were willing to scale in higher and they shorted here, this would be a good location for them to short again. And by the close of this bar, they probably would place their stop on their entire position above the high of this bar. That would be two strong bear bars. This would be an extremely strong bear bar. The bears probably would not allow the market to get above the high of that bar. And this is what happened after that second entry, a very strong bear breakout bar. At this point, traders would tighten their stops to one tick above its high. And once the market had this strong bear spike, 4 consecutive bear bars down, they might start talking about moving their stop to break even. I probably would not. I would wait until after we've had one push up. So after we've had this push up and then a new low, I might put my stop at break even. Maybe slightly above here. I don't think I would. I would probably keep it up there around break even. Double top bear flag. Bears would short again either below this bear bar. That would be a good choice. Maybe below that bear bar. And then a possible final flag here. A low to short late in a bear trend. Possible final flag. A bull reversal bar. This is a good location to take final profits. When you're scaling into a trend, when there is a strong spike, traders will trade in the direction of the trend, and many will enter on the close of bars. For example, scaling into a bear trend where there's a strong bear spike, traders will short, and they may short more on the close of every successive bear trend bar all the way down until the market reaches some support level. If you're selling closes in a bear trend, you can keep doing it until you're down to a support level, and then it's better to stop doing it. Here we had a gap up, a big pullback, and a channel. Possible new high of the day of a trading range day. And we've had 3 bear bars, and the bodies are starting to get bigger. So the market is probably always in short at this point, which means there probably are sellers above the high of this bar. Maybe with a stop above the high of the day, maybe with a stop above the high of this bar. In any case, the market's always in short at this point, and traders will get short. So they'll start selling closes, and they'll also place limit orders to sell above the high of the bar. So let's say a trader sold the close of this bar. And then we have another bear bar closing. They could sell the close of this bar. They could sell the close of this bar. So they're adding to their shorts. Their stop at this point is probably above the top of this bear spike. We've had 5 consecutive bear bars, so that's a good enough bear spike. The market's always in short, probably since maybe this bar. Traders would not want the market to come back above the top of their spike. Now we have a stronger bear breakout, but we're getting close to the bottom of the channel. We had a spike up in a channel, and the market often finds support in the neighborhood of the channel. You can sell this close. I would be nervous that this could be an exhaustion gap, a sell vacuum down to the area of support. So if anything, I would be looking to take partial profits. Okay, so if you sell this close, I think you have to be willing to scale in higher, because this is a possible exhaustion bar, a sell vacuum down to support levels. Prior swing low, we found buyers over here, right? We found buyers here, and we're back to that general area again, testing the breakout point above this bar, also testing the open of the day again. So there are a lot of things going on here. Also, now we've had 6 consecutive bear bars, which is getting extreme, and traders will start looking to take profits. So if you sell this close, you have to be willing to scale in higher. There are many ways to do it. You could sell above the high of the prior bar. You could sell a fixed number of ticks up, like 2 points up, or you could sell a pullback, like maybe 50% retracement. With all trades, you don't want your risk to exceed your comfort level, so you have to make sure that the total risk for your combined position of all your trades is not too big. So you trade either very small or not at all. If you're not willing to keep your risk within your comfort zone, it's better not to be scaling in. So let's say a trader shorted this close, right? And they have to be willing to scale in. They're assuming that the market is always in short, so that there are sellers above, and they'll look for ways to sell. One is to sell above the high of the prior bar. So they might short, let's say they shorted above the high of this bar. Another is to sell about 50% of the retracement of the bear spike, so that's right around here. They might also sell below this bear reversal bar. Those are all reasonable ways to add to your initial position down here. Again, your initial stop is up here, so your position sizes have to be appropriate so that your actual risk is no bigger than on any other trade. Now, a lot of the traders who sold here and watched the market get up here, at this point decided that this was probably a bad place to go short. So they'll be happy if the market comes back here, and they'll get out break even on this short and take profits on those. So whenever you take a short in a situation like that and it turns out to be a bad short and you scale in higher, most traders try to get out around their original entry price. So they get out around break even on their first entry and they end up with a profit on their subsequent entries. So in this particular case, the market started to come down, and traders would exit part or all of their shorts at this level. So they would get out of this short at break even, and depending on which short they took up here, they would end up with a profit on that short. If they saw these 2 strong bear bars and decided that we're probably going to get a leg 1 equals leg 2 move down, here's leg 1, here's the start of leg 2, they may have been willing to swing part of their trade. The screen is in a trading range. We're near the bottom of the range. We have a big tail, a pullback, possible 1-bar final flag, and a big tail. Near the bottom of the range, traders bought over here, and they bought over here, and we're in this price level again. We have about a leg 1 equals leg 2 measured move down. And you could argue that it's a large wedge bull flag, 3 pushes down, 1, 2, 3, or you can even argue the first push is here. So you can draw a trend channel line below. We had 2 attempts to break below the bear channel line, and we're reversing up. So lots of reasons why bears would take final profits in this area. That's the end of the module on scaling in. This is Al Brooks, and this is my price action trading course. This module has to do with taking profits. You need a plan to manage a winning trade, and you need to protect your profits as you let them grow. You also have to take profits before they disappear. The tools that you use, first of all, you begin with a protective stop. Next, you trail the stop as the market goes your way, and you can also use break-even stops. You want to take profits before they disappear. You need goals when you entered the trade originally, and you adjust your goals once you see the strength of the move. When you enter a trade, if the goals are really not all that clear, rely on defaults. For example, you'll put an initial risk beyond the signal bar. For example, if you're buying, you put your stop below the signal bar, one tick below, and you take partial or full profits at twice your initial risk. And if you took partial profits, you swing the balance. In terms of scaling out, if you are trading a big enough position that would allow you to scale out, you might take half off once the profit reaches twice your initial risk, take another 25% off at 3 times your initial risk, and then swing the balance and trail the protective stop and look to exit before the end of the day if it's a day trade. Once the trade goes your way, you should look to adjust your profit targets based upon your actual risk instead of on your initial risk. So you would take half off at 2 times your actual risk, take another 25% off at 3 times your actual risk, and swing the final 25%. As an example, let's say you buy 400 shares of the SPDR, the SPY, which is an ETF, and you bought them at 140 even. If the signal bar is 22 ticks tall, then you're buying 400 shares on a stop at 1 tick above the high of the signal bar. Your initial protective stop is 1 tick below the signal bar. So your total risk is 24 cents. The signal bar 22 cents tall, you buy 1 cent above, you stop 1 cent below. So a risk of 24 cents, and you have 400 shares, so your total risk is $96. Although this example is based upon the SPDR, the SPY, this example is to illustrate trading principles, and I actually modified the prices slightly to be able to use round numbers. But the prices that I am citing in this example are very close to those of the actual day. Here's an example. You have a gap down with a very strong bull signal bar. The signal bar is 22 cents tall. If you're buying on a stop, you're buying at 1 tick above, and your stop is 1 tick below, so your total risk is 24 cents, 24 ticks. You set up your initial targets based upon your initial risk. Your initial risk is 24 cents. 2 times your risk is 48 cents, so you take half off at 2 times your risk. 3 times your risk is 72 cents, so you take another 25% of your trade off here, in other words 100 shares, and then you would allow the final 100 shares to continue in the market as long as the trend continues, relying on trailing stops below the most recent high or low, and you try to exit right before the close. After you enter, if you see the market pull back like this, that is not a strong sell signal bar, so you rely on your initial stop and hope for the best. Here you can see a big tail on the bottom of this bar, and that's caused by bulls aggressively buying, trying to prevent the market from coming down, hitting their stop, so the bulls are adding on. As the market starts to go up, as this bar is forming, as this big bar is forming, you quickly determine what your actual risk was. You know, where did you have to have your stop to not get stopped out of the trade? Well, if you bought here and the market started to turn up here, you would not have been stopped out if you had your stop one tick below the low of this bar. And that is 21 cents below, that's 20 cents below your entry price, which is above the high of this bar. So your actual risk is one tick below the low of that bar, and that price, that red line, is 20 cents below your entry price. So your actual risk is 20 cents. You'd quickly figure out where 2 times your actual risk is, 40 cents. So 2 times your actual risk is this blue line, this red line, and the market went one tick above it. So you would have exited half of your position, 200 shares, at 2 times your actual risk of 40 cents. And you can see that tail there indicates that a lot of traders did the same thing. So the market rallied to 140 and 40 cents. It reached the minimum target of 2 times the actual risk, or 40 cents. You take half off 200 shares at 140.40 on a limit order, and you have so far locked in $80 profit. 40 cents times 200 shares. You have 200 shares remaining. If you get a possible sell signal, you could either exit your remaining 200 shares and look to enter again later, or you could continue to hold and rely on your protective stop. Okay, so after you took off 200 shares, you have 200 shares left. The market did not reach 3 times your actual risk, your second profit target, and instead it developed a wedge shape and a failed bull breakout. So this is a possible place to exit. I don't know about going short. I would not. I think the market's always in long. However, the stop for an always in long position, a swing trade, is below the most recent higher low. So it would be below this bar, which was where you moved your stop after the market turned up. If you do choose to exit here and the market sells off, you can always look to re-enter. This is a reasonable thing to do. It is reasonable to exit here because of the wedge shape. We may get a pullback. In fact, the bears developed a very strong breakout. So you could have exited there, or you could have held, and we have 2 legs down, 1 and 2, which is common after a wedge. But look at this bear breakout. What kind of follow-through did it get? It got a very strong bull reversal bar. So that is a failed breakout setup, a failed bear breakout setup. The market fell to below the entry price, so it would have stopped out weak bulls who moved their stop to break even too early, but it would not have hit a stop below the bottom of the bull spike. Very often when you have bull trends that don't look particularly strong, you get a very big sell-off, but it does not hit a stop below the bottom of the spike. And this was probably a sell vacuum test of the weak longs. The longs who put their stops at break even, the market quickly came down, wiped out those stops, and reversed up. Okay, so we have a wedge and 2 small legs down, and a bear breakout and a signal for a failed bear breakout. This is a pretty good looking buy signal bar, and if you understand what's happening, that this might be simply a sell vacuum to wipe out weak longs, it's a reasonable buy signal. It's also a higher low major trend reversal. We had a bear trend, a strong rally, and then a 2-legged sell-off and a strong reversal. So if a person was flat at this point, for example, if they exited up here, this would be a good place for them to re-enter for a swing long. Some traders, if they took half off up here, they might put their second half back on. So for example, some traders might buy at 1 tick above the high of this buy signal bar. In the example that I'm giving, I'm going to rely on the original entry back here and not discuss a second entry over here. If the bull resumes, okay, if we start to rally again, at that point, I personally would move my stop to break even. I don't want the market to hit the break even stop once, rally strongly, and then come back and hit my break even stop a second time. That's not the way I want the market to behave if I'm looking for a swing long. And every time the market tests the high or goes to a new high, I'll trail the stop up to below the most recent higher low. So for example, when the market runs up here and tests the high, I would move my stop to below this low. When the market comes up here again and tests the high, or maybe up here after it actually goes to a new high, I would trail the stop up to below this most recent higher low. If this is a bull trend, I want it to keep forming higher lows. Right now, it is a bull trend. It's forming higher lows. Not quite forming higher highs. We finally got one here. But it's also a trading range. So at the moment, we don't know if this is going to remain as a trading range or if we're going to continue up in a bull trend. We're just below the target for the second exit, and we're getting a bear reversal bar. So that is a problem. Traders will probably look to exit below this bar, especially since it could be a failed breakout above the top of a trading range. This pink box shows that we're in a trading range. We've been sideways for hours, and I think most bulls would exit below this bear bar. So if the market falls below this bear bar, the bulls will just exit. Bears might short because it's the top of a trading range. The rally up is not all that strong. We've had selling pressure on the way up, and it is a reasonable short. Personally, I don't like to reverse except under exceptional circumstances. So most of the time, if I'm long, let's say I bought here, or if I bought here, or if I bought here, or even here, I would exit my longs below here because this is a reversal down at the top of a trading range. We have pretty good selling pressure throughout the trading range, and we have a bear signal bar. A small body, so it's not a particularly strong signal bar, but it is enough for me to exit a long. If I were flat, I would consider going short, but I don't like to reverse because it's too much to process. I'm trying to think about the bull case and to also think about the bear case and to make the trade and do it correctly, place the orders correctly, all within a very short time, is something that I don't reliably do. So I'd rather, if I'm thinking about getting short, I'll get out of my long over below this bar and then wait a few bars to see if there's another sell signal and then take the second signal. Okay, over here, the market did not trade below the low of this bear signal bar. The market had a little inside bar here, and instead of going below it and below the bear bar, it found buyers right at the low of the bear reversal bar. So that's a sign of strength by the bulls. They prevented the bears from triggering a short and from running the stops. A lot of bulls would have gotten out below this bar, but the market did not get there, so that's a sign of strength. The market went a tick or so above the 3 times the actual risk, so bulls can take off another 25% of their position, 100 shares, at 60 cents profit, and then trail stops below the most recent higher low. So you take another 25% or 100 shares off at 140.60 for 60 cents profit, which is $60. 60 cents times 100 shares, 6,000 pennies, that's $60 profit. Okay, this is the last bar of the day, and we're still rallying, and most bulls would get out right before the close. They might get out here on this weak bear close after a possible exhaustion, but let's say you exited right before the close. You would have exited with 85 cents profit on your remaining 100 shares. You would hold those 100 shares until the market was no longer always in long, or until there was a sell signal, or until the market hit your trailing protective stop, or until moments before the close of the day, which is what we did in this particular case. So when you took your final profits on that remaining 100 shares, you made $85 on that final 100 shares. Your total profit is $225. Your initial risk is $80. Remember, you had a 20-cent stop and 400 shares. So on your first 50%, your first 200 shares, you made $80. You exited at 140.40. You took another 100 off at 140.60 for another $60. And you took your final 100 off at 140.85 for $85, giving you a total profit of $225 on your 400 share trade. Well, let's say you were a little richer and had a bigger account. So instead of trading 400 shares, you traded 4,000 shares. The spider can easily handle 4,000 shares. And in that case, everything would be tenfold greater, and your final profit would have been $2,225, and your risk would have been $800 instead of $80. Well, let's say you were trading even bigger. Let's say you're a fund manager, and you were trading 400 E-mini futures contracts instead of 400 spider contracts. Then everything would be substantially larger, and your final profit would have been over $100,000, and your initial risk would have been $40,000. And the E-mini futures market, the futures market can handle 400 shares. That is not an unusually big trade for the E-mini futures contract. Sometimes when you're in a position, a swing, your profits grow very large, very fast. You always have to keep your dollars at risk below your maximum. You have to reduce your position size based upon your current stop. You keep trailing the stop up, but as the market gets further and further from your stop, let's say in a bull trend, the market keeps rallying, your risk is greater. You know, every now and then you'll hear someone say, "Oh, it's okay, I'm trading somebody else's money." You're not trading somebody else's money. You're trading your money. Once it's in your account, it's yours. And trade it like it's yours. And keep your risk, your maximum risk, the same. Don't increase your risk. So for example, let's say your normal risk is 20 cents in the spider, and you normally trade 500 shares. So your total risk, maximum risk, is 1,000 ticks. Do not risk more if the profit grows. For example, if the market rallies and you're long, and the stop, your trailing stop is now 40 cents away, that means you're risking 2,000 ticks instead of 1,000 ticks. Take half off to get your risk back down to 1,000. You can always put your full position back on, the other half back on, during the next signal. But at the moment, your risk is 2,000 ticks, and your maximum risk is 1,000, so you have to take half off. Here's an example of what I mean. So if you buy here, and the market starts to get very far above your trailing stop, take half off. You can say, well, Al, this is another buy signal, a very strong breakout. This is another buy signal. That's fine. You know, I would still rather take some off because, you know, when you have a profit and your risk is getting big, it's always better to take some off because you don't want to take a chance of giving it all back. So let's say at the close of this bar, your stop is here, and let's say that comes out to a risk of I don't know, 1,500 cents, 1,500 ticks, and your normal maximum is 500. I would take 100 or 200 shares off. And let's say the market gets up here and you trail your stop here. Okay, you're still risking about 1,000 ticks. You can stay the same. Let's say over here the market starts getting very far above your stop, and your risk is up there at 2,000 ticks, and your maximum risk is normally 1,000. You got to take some off. You know, if you take some off in here, you can just put it back on the next signal and then start the process over again. So if you buy above this bar, your stop is now here. So just make sure that whatever position you have, you're not risking more than your 1,000 ticks. But the important thing is, whenever the market starts getting very far above your trailing stop, your actual dollars at risk are increased. You know, it is your money. It's not open profits. You know, that is money in your account. So manage your trade as if it's your money and calculate. Always be aware of how much money you're actually risking. A lot of times when the market's going up like this, and the market's over here, the trader thinks his stop is down here, but he's really not risking that. Let's say he keeps his full position on, he'll get out long before this. So he thinks this is his stop, but it really is not. It'll be somewhere up in here. So, a lot of times, if he keeps his full position on, that's okay, as long as he's honest with himself and he's not actually using a stop way down here. If he's extremely disciplined and he truly is going to rely on the stop, he has to reduce his position size. On the other hand, the market's moving quickly, he's long, and he wants to take a chance. That means even though he might tell himself his stop is here, it's really not. He'll probably get out here if he has his full position size on. If he reduces his position size, he might get out down here. Key point is just keep the total dollars of risk within your comfort zone, and if your open profits are growing very big, either reduce your stop or reduce your position size, because you don't want to go beyond what you normally risk. Let's say you're talking about a possible very big trend. You have to adjust your goals. You have to you can use a default protective stop and a default position size, but don't use your default targets. You have to adjust your targets if you're looking for a really big trend. If that's the case, if you have an average size signal bar, so you have an average size stop, but you think the profit may be very large, but you're not sure what the profit target should be, don't place the profit-taking limit order when entering the trade, or place the order very far above your entry price if it's a bull trade. If it's a bear trade, put it very far below the entry trade. You want to wait to see if the move is as strong as you think it will be, and if it's not, then use your default profit-taking at 2 times the risk. Let the market dictate where you should take partial profits. Instead of trying to take partial profits at 2 times the initial risk, if this looks like a potentially very big move, you could take half off at 2 times your risk and swing the balance. But if it looks like it's going to be a very big move, you can move your profit target for your first half to substantially bigger, and rely on the price action to dictate where you should take profits. Okay, look at Baidu. This is a huge sell-off, a very strong sell-off over the past day or so. We have a very strong bear spike, 3 strong bear bodies, 5 of the first 6 bodies over here in this spike were bear bodies. And we have a wedge pullback to the moving average with a very strong signal bar at the moving average. You could bet on a potentially very large move. Your initial stop would be above the high of the signal bar. You'd enter 1 tick below the low of the signal bar. You could, if you wanted to, take half off at 2 times your risk, or you could wait to see just what happens here and then place a profit-taking limit order. 2 times the risk looks like it'll be above the bottom of the bear spike, and we could get a leg 1 equals leg 2 move down. So if you wanted to, you could take a chance and not put a profit-taking limit order in this area at 2 times your initial risk. Instead, put it down here or off the screen and wait to see how the market behaves. And if it's not falling too quickly move it up to 2 times your risk. If it's collapsing, you keep it down here and even drag it down further. Okay, so if you're going to use your defaults, your initial risk at 1 tick above the high of the signal bar. If the signal bar is 30 ticks tall, your risk is 32 cents. You entered 1 tick below, your stop is 1 tick above. Okay, you took the short, and you have a very strong pullback, possibly a failed breakout, possibly a higher low major trend reversal. We have a bear trend, a pretty good move up, about 10 bars, and the bears tried to break the market out, and instead it might be forming a higher low major trend reversal. Could you buy this? If I were short, I would not be thinking about going long. I would be relying on my initial stop for my swing, and I would be holding short. Now at this point, what do? If you are already short, you don't do anything. If you bought above this bar, this would be a big problem for you. You have a bull breakout, but immediately a failed breakout possibility on the very next bar. So the bulls would probably get out below that bar. Traders who are totally flat, they see this as a double top bear flag with a very strong signal bar at the moving average. They would go short at one tick below the low of this bar. If you're already short, you might add to your position if you feel particularly aggressive. Still not much going on. Not a strong entry bar, not strong follow through. Okay? If you were going for an initial target of 2 times your initial risk, that would be 64 cents down here. You could also adjust it based on your actual risk, but it's not much different. Your actual risk, once this bar formed, you would assume your actual risk was to 1 tick above the high of this bar. It's just about the same as your initial risk. You could switch over and exit at 2 times actual risk. You could keep it at 2 times initial risk, or you could take a chance that you'll get a very strong leg 1 equals leg 2 move down and not exit until you see more of the move. Alright, if you did not exit half at 2 times your initial risk and you saw this huge bear breakout bar after this bear bar, after the double top bear flag, you would be thinking that there's a chance we could get a leg 1 equals leg 2 move. And if you saw this, you could take some off here, maybe take off 25% instead of 50%, or you could keep dragging your profit-taking limit order further down to see if we quickly get a leg 1 equals leg 2 move down. Regardless of what you're doing with your profit-taking limit order, we have a very strong bear spike. I would lower my protective stop to above the top of the spike, maybe even to above the top of this very big bear bar. Okay? When the probability of the move is high, here we're in a very strong bear trend, so we're probably going to fall further. So your probability is high. You're pretty confident, 60% or more. You can take some off or all off at only 1 times your risk. The trader's equation is positive when the reward is equal to the risk when you're confident of the move. Here you look at that chart and you say, yeah, this is falling. I'm confident it's going to fall more. When that's the case, the probability is high. You can go for a reward that's equal to your risk instead of twice as big as your risk. So what is your risk? I usually use the open of the spike to the close of the spike. So at the moment, this pink bar is what I would use for the measured move target. So the open of the first bar to the close of the second bar, it's $2.03, and this would be my target. So at this point, I would be pretty confident, 60% confident, that the market's going to fall to this point. So if I were still short my full position, I would take half off once the market got here. So at this point, I would place a limit order to take half off at this point. You could take a chance that it's going to collapse, but to me, I think it's a pretty reasonable target to take half off here and see how the market behaves if it gets there. Okay, what happened? Okay, no pullback. The spike is growing. So at this point, the spike is now this big. Instead of this big or this big, it's all the way down to here. As the spike is growing, I'm going to keep lowering my profit target based on the height of the growing spike. So with the close of each bar, my pink box gets bigger and my profit target gets bigger. So I keep adjusting my profit target as the spike grows. Traders will continue to sell closes. They'll sell this close, they'll sell that close, they'll sell this close, they'll sell this close, but they'll make sure that they don't exceed their comfort zone for their maximum dollars at risk. You don't have to sell every close. You could sell 1, you could sell 2, you could sell 3. It doesn't matter. The market has a high probability of going down equal to a measured move based on the height of this spike from the open of the first bar to the close of the final bar. Okay, the market's pausing in here. So at this point, the initial spike has ended. So this would be my target for taking profits, either full profits or partial profits. Now that the market's resuming down again with a pretty big bear bar closing on its low, I would lower my protective stop to above the high of this pullback. Okay, the market is still falling. Another strong bear bar, a big bear bar closing near its low. I would feel comfortable trailing my stop to one tick above its high, especially since at this point I have a large open profit. If I were flat, I would be selling closes. I'd sell that close, I'd sell this close, and I would keep selling closes until there's some sign of a bottom. Okay, now what happened? We fell below the measured move target. We had a bear spike, a pause, and then we hit the measured move target, and we hit it in a very big way. The bear bars are getting bigger, closing on the low tick. To me, I would exit my total position. This is a series of consecutive sell climaxes. We sold off here, we sold off very strongly here, and even stronger here, and the very best bear bar of the entire trend is occurring right at resistance level, right at a support level, right at my measured move target. So for me, I would go totally short here, knowing that the market may go down a little bit further, but I would take full profits. In this case, it would be $8.35 in Baidu. But we're at a support area, a measured move, and we're having consecutive sell climaxes. So we might reverse here, or we might reverse soon. And this is what happened. We had two more little pushes down, and a little wedge bottom, 3 pushes, 1, 2, 3, and a bull inside bar, a tail on top, so not great, but the context is good. After a series of consecutive sell climaxes, and now we have a little wedge bottom at support, a double bottom at support, or triple bottom at support. Remember, support was here, the measured move. To me, I personally would go long here, and I would look for at least 10 bars, 2 legs up to at least the measured move, maybe to the top of the bear spike. And had I bought here, I would be holding long and looking for at least 10 bars and 2 legs up. Okay, we're going into the close. We're getting a 2-bar reversal. We're getting a series of bear bars. I would exit my long at this point. Where would my stop be had I bought here? In fact, I did buy here on that particular day, and I did sell up here. But had I bought here, my initial stop, probably I would have put it below the low of the signal bar. I might have used a wide stop, like based on the height of this spike. I might have put a stop, a measured move down. But given this particular setup, I personally just put my stop below the low of the signal bar and took my chances. Initial risk versus actual risk. The initial risk is the number of ticks to your protective stop, your original protective stop. The actual risk, I've talked about this many times, it's the number of ticks plus 1 that the market moved against you before resuming towards your target. So, for example, if I bought and then the market rallied and then it came down but did not hit my stop and it rallied up again, had I had a stop in the market that was 1 tick below that higher low, I would not have been stopped out. That is my actual risk, and I can adjust my profit targets based upon the actual risk. It's the number of ticks that I would have had to have to not get stopped out of the trade. It's sometimes reasonable to convert a swing trade into a scalp. Most swing trades start with low probability, but in the breakout phase, the probability of a successful trade is often 60% or higher. When the probability is high, you can exit with a reward that is equal to the risk. You don't have to go for 2 times the size of the risk. You'll still have a positive trader's equation when the probability is that high. And when that's the case, it's okay to scalp. An example, let's say you have a bull breakout late in the day, and you start to see some evidence of two-sided trading, and you're not certain that the market will go far enough your way before the end of the day, or if it'll pull back first. However, you're willing to take a chance, and you're willing to rely on a swing stop. Then you go ahead and you buy it as a swing. If the market quickly goes your way, and it reaches a reward that's at least as big as your actual risk, you can scalp out, and that's a mathematically sound thing to do. In the breakout phase, the probability is 60% of higher prices, and if you get that right away, you can scalp out. If it goes against you, either you can rely on the swing stop, or you could add on lower. And if you add on lower, you can look to exit the entire position at your first entry price, getting out break even at your first price and with a profit at your second, or you can just hold and see if you get a big move up into the close. So how do you determine the actual risk? After you enter, you count the number of ticks that the market moved against you before it started going your way, and you reduce your target to that number of ticks, and that converts the swing into a scalp, and it maintains a positive trader's equation. For example, here we have a market that is becoming clearly always in long. We have a strong bull breakout, 3 strong bull bars, and it's getting late in the day. We're in the final hour. So the swing stop for anybody buying at any point and for any reason here would be below the bottom of the spike. This is after a lower low major trend reversal. We had a bear trend and a break above the channel, a break above the trend line and above the moving average, and then a lower low major trend reversal, and now we're getting a lot of buying pressure, a lot of consecutive bull trend bars, and here we're getting large bull trend bars, so the odds are high that the market's going higher. Anyone who buys in here has to rely on a swing stop which is below the bottom of this spike. Okay, at this point, look what happened. We had the doji bar for the failed breakout attempt. The market went 1 tick below and quickly reversed up into an outside up bar. But the market went down on this bar and then up, and down on this bar and went up. So it's a micro double bottom, and a micro double bottom is a small high 2 buy. Any double bottom is a high 2. So you can buy above the high of this bar. But when you're taking that buy, if you're taking it as a swing, your stop is below the bottom of the spike. However, these dojis, and we're near the top of the day, these dojis represent two-sided trading, and it's possible that the market may not go straight up. It may go up a little and then pull back and then go up again. So if you take this buy, you're at first relying on your swing stop, and as soon as it starts to go up, you quickly calculate your actual risk. And in this particular case, the market at most went 2 ticks against your entry price. We had the entry 1 tick above this bar. The market traded 1 tick below the high of the bar, 2 ticks below your entry price. So you would have needed to have a stop 3 ticks away to be in the market as it was going up. I never go for a trade with 3 ticks profit in the E-mini, but I do sometimes go for 4 ticks. So in this particular case, late in the day, I often would quickly place a limit order to exit out 4 ticks above my entry, and I would have been filled. So I would have converted my swing trade into a scalp. Had the market instead gone down, I could have added on 1 or 2 points lower, and then wait for the market to come back to my original price, and then exit the entire position. My first entry, I'd get out break even, and on my second entry, I would get out with a profit. If I did do that, I would still be using the swing stop below. And this is what took place. So you could buy 1 tick above this bar. You'd be able to scalp out with 4 ticks. And it turned out the market went higher. So if you bought it as a swing and relied on the stop, you would have made probably about 4 points. After the market went above this high, you probably would have trailed your stop to below the most recent higher low over here. And once it went above here, your stop would be down here. You only have a couple bars left in the day, it doesn't really matter. That's irrelevant. And you would exit in the final seconds before the close. When you're doing trades, when the market is doing this, lots of reversals, relatively big bars late in the day, you got to be very fast. Remember, you're going to be tired after trading all day, and these bars and these reversals happen very quickly. It doesn't look necessarily like they're happening quickly on the 5-minute chart, but many of these bars go up and down repeatedly as the bar is forming. So you have to do a lot of thinking, and I think it's very difficult to do. Best thing to do, you can scalp out, which is an easy way to do it, or you can just take the swing trade when the market gets up here, put the stop below this low, and keep your fingers crossed that the market will rally in a channel up for the rest of the day. We have a spike here, so chances are we're going to be in a channel. We have two-sided trading here, so the market might be entering a channel, and it turns out that it in fact ended up as a channel for the rest of the day. Well, what happens when the signal bar is small compared to the trend that the market is in? Do you still go for a profit target that's 2 times the size of the risk, 2 times the size of the signal bar? Not necessarily. Let's say the signal bar is 1 point tall and your default risk in the E-mini is 2 points. Instead of going for a target that's 2 times your risk, in other words 2 points, you could go for a target that's 2 times your default risk, or 4 points. Here's an example for the spider. If you normally risk 20 ticks and the actual signal bar height is 8 ticks tall, so your actual initial risk is only 10 ticks, and the market's moving in a big way, instead of going for 20 ticks, you may go for twice your normal default risk. If you normally risk 20 ticks on a trade, try to exit half at 40 ticks, twice your default risk. If you're trading another stock like IBM, for example, and you normally risk $1, you could exit half at $2. So here's an example. We have a pretty big move in the spider. The market's down about 80 or 90 cents inside of an hour or so, and we have a relatively small signal bar, about 10 cents tall. You could exit at 2 times your initial risk, which would be right here, and then move your stop to break even. Or if you wanted to, you could go to a bigger target based on the size of the trend that occurred before. In other words, don't exit, just hold and wait for a reversal, like maybe possibly exit some over here. A little parabolic wedge, 3 pushes, 1, 2, 3, after a sell climax. Around a measured move down from the high of the day to the open of the day to a measured move down. Sometimes you'll get days like this that trade up and trade down, and a lot of times they'll find support at a measured move from the open of the day to the high of the day, so somewhere down here. And those days oftentimes get back to the open, and then the bar on the daily chart ends up as a perfect doji bar. So you have to be aware of that possibility, and that might have been what the market was trying to do right here. In any case, let's say you took some off at 2 times the risk, or you took some off above this small bull reversal bar, and you let the rest go into the close. Down here, you probably would exit the final amount going into the close above this bull bar. Another parabolic sell climax, 1, 2, 3, and you have this slope, and then the slope is getting steeper, and we have a failed bear breakout below this breakout pullback, bull body, another bull body, and only a few bars left. I personally would buy back if the market went above the high of this bar and close out the remainder of my position. Okay, so let's say in this example your default stop is 20 ticks. Instead of going for 2 times the initial risk, which is 2 times the actual risk, instead of going for, in this case it would have been about 20 ticks, you could go 2 times your default risk, which is down here, and you would have exited over here. And that's the end of the module on taking profits.